CapEx every quarter to buy these chips. Now, they could develop their own, and that's a big risk for NVIDIA. That's what investors want to know, because they're up against the large internet and cloud companies when it comes to competition.
What about national security concerns at a time where a lot of people are gaming this out as the next big thing on both the good side as well as on security sides and concerns? Does it matter which areas of the world are buying NVIDIA chips most, where they see the growth now, but that could come into focus politically?
I mean, think about, how these chips are being consumed. They're being consumed on the cloud and on the internet. And cloud and internet serves everyone. So the physical location of the data center doesn't matter. Yes, the buyers may vary. It could be a Baidu or a Tencent, or it could be a Meta or a Microsoft or an Amazon. But ultimately, that's where this Gen AI chip capacity is being used.
I'm mentioning this because Saudi Arabia made a massive investment, I believe, in NVIDIA and is trying to expand in artificial intelligence in a meaningful way. We know that there have been issues with China and some of their development of artificial intelligence. I'm just wondering how this plays into NVIDIA as they expand globally at a time where there have been concerns raised about how some of this technology is going to be used and where the chips are really going.
Yeah, so far the export restrictions have been more on the leading node chips. So they have their latest H100 chip. They came up with a lighter version that's not based on the leading edge, or it has all the features, and that's what they are selling in these markets just to avoid the restrictions. But ultimately, everyone is looking to buy these GPUs because that's how you develop your large language models or you do your inferencing. And I think with NVIDIA, clearly they have the technology. They just have to figure out how to work through these export restrictions.
You're talking about paint drying. Mandeep Singh scheduled to be at the Battery Management Solutions Seminar for Texas Instruments in Dallas in October. That sounds like a bundle of fun. I want you to take NVIDIA today and extrapolate it out, obviously, to Microsoft, but to the Texas Instruments of the world, the silicon substrates of the world. Can you do that, or is it just discrete to NVIDIA?
No, actually, so Microsoft in their earnings said they are going to see a 1 to 2% point growth lift from Gen AI workloads.
Growth lift where on the income? Revenue?
On the Azure line, on the Azure revenue.
On the Azure line,
yes.
the subdivision,
yes.
the cloud division.
And so Google said they could see something similar. AWS, on the other hand, hasn't called out any growth lift because they are bigger in size.
They're working a 3-day work week. That's what that's about.
And so it does come down to, how the cloud guys actually make that available. I mean, ultimately,
the cloud guys are working a 2-day work week.
I hope that if productivity goes up this time around, we actually work less, but I fear we won't. Mandeep, thank you. Mandeep Singh of Bloomberg Intelligence. Let's get these two names on a screen. Foot Locker, Nike. Foot Locker cutting their outlook, a new range for you on earnings per share, 130 to 150. Previously, 2 to 225. The estimate, 198. The stock down 24%. Weakness in the month of July. Tom, inventories much higher. Stores being closed. It sounds brutal, doesn't it? This is the kind of move we saw yesterday on Dick's Sporting Goods. You're seeing it on Foot Locker right now. And Tom, that 99-day losing streak could well become 10. That stock, 99, we're down by 2.4%.
I'm going to go to this phrase, John, I hate, omni-channel, which I've hated from day one. Oliver Chen taught it to me. What's he know? But the bottom line is Foot Locker I perceive as stores and malls. And the answer is, are we buying all of our sneakers off the internet now, where Foot Locker's cut out versus other providers?
Possibly, to some degree.
I'm just making this up.
But Tom, for Nike right now,
can you see me in a
they've
pair
got a
of
problem
Nikes?
over in China as well. Weakness there too.
Can you see me in a pair of Air Jordans?
Yes, I can. I can see that working. I can see that working. What are you wearing now? Pradas?
I got my Jackson Hole shoes on. They're like,
ready to go. Thanks for interrupting what was otherwise going to be a serious conversation about what's happening in retail, TK.
Retail's getting hammered. That's the discussion.
Well, it's more than that, though, right? There's a larger question here about discretionary spending and whether the savings is really coming up. There's a larger question about whether this is the weakest players getting beaten out during a high-rate environment, or whether this is something broader that really speaks to a consumer. I keep going back to what the Macy's CFO said yesterday. The speed of the increase in bad debt since the first quarter was faster than planned. Charge-offs, concerns about ability to spend. Yes, there's specific stories. There also is something else going on here.
What we've heard from these retailers in the last week is inconsistent with what we see at the headline, the labour market. Lizanne did a wonderful job of going through some of the weakness you see elsewhere. But Tom, right now, the headline is 3.5% and payrolls growth is pretty decent. The guide you're getting from some of these retailers is not that consistent with that.
I just looked down at Mandeep's shoes. He's wearing the Roger Pro Clay.
How much are they?
like $300 a pair. You know, he's like all tennis.
They're expensive,
You didn't get them
right?
at Foot Locker.
Nice. Like Federer
He's like,
own brand. Is
Get
that what
me
that
off
is?
this set.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
How high can rates go before it becomes almost self-limiting?
The policy rate is going to rest on a high plateau for a while. That's going to feed into longer-term yields.
We're still within that transition period where we could have a very interesting trend environment.
We had the biggest surge in inflation in 40 years, and while headline has come down, core is still sticky.
We're seeing some cracks in the consumer, but broadly speaking, we still are pretty upbeat.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Retail is not having a good time. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market's just about positive by a third of 1% on the S&P. It's the big one a little bit later after the close. You'll hear from Nvidia already this morning. Another retailer in a world of trouble. Foot Locker down in the pre-market, Tom, by 25%. A quarter of the market cap gone. Just like that.
On the break, when you saw Big Little here, Bramo was really intelligent here on the split here economically. This is not about luxury. Even LVMH is off, Hermes is off, da-da-da-da-da. This is about America in a certain part of America flat on their back, and that's the tension that you'll hear at Jackson Hole. I'm going to suggest Jerome Powell will address this middle part of America that feels like they're in recession, and you see it in Foot Locker this morning.
Just some warnings starting to pile up, Lisa. You mentioned Macy's and delinquencies that they flagged. We can look at what we heard last week from Walmart and Target flagging student loan repayments. They were flagging that as well. And then Dick's Sporting Goods, a world of pain yesterday for them as well.
And so some people might say, well, these are each specific stories that are losing share to others. It doesn't necessarily represent the entirety of consumers. They still have money, although it's running out. That said, clearly the buck is starting to stop. And if a company is weaker and they have to borrow money to keep their business model going, they are going to get weeded out faster. This is what happens when an era of free money ends. And this is where you're going to see these potholes that continue to accelerate and may indicate something broader.
2023, the great zombie roll-up. When I invented that phrase, Lisa, I did not think about 5% 2-year. I did not think about the brilliance from Katie Kaminsky, I think yesterday, about looking at 6% is a what if. I did not think about moments ago, a mortgage headline comes out across the Bloomberg, a 7.x%. That's how you get to a zombie roll-up.
When mortgages cost that, Tom, you don't buy.
The
and
math,
that's what's happening.
Exactly.
Yes.
Home purchase applications dropping to the lowest since 1995. Surprise, surprise, as the 30-year fixed mortgage rate jumps to 7.3%, the highest since 2000. You've got the price tag, Lisa, and then you've got what people are actually paying, and it's far less than 7%, given the average rate on mortgages right now. The effective rate is much, much lower.
So have we seen the effect of monetary policy? Have we seen the effect of higher yields if no one's actually paying them and if people are doing everything in their power to avoid paying them? And this is sort of the existential question that I want to hear from Jay Powell and, frankly, in more the side chatter at Jackson Hole, where there's this feeling of victory. We did it, guys. This is a good thing. We're seeing the likelihood of a soft landing increase. Is it? Or are we seeing just markets adapting for the time being, holding out hope that the Fed's going to cut rates sooner?
The charts give pause. You look at the Wall Street Journal article yesterday, Colby Smith overnight in EFT, what Bloomberg Economics is doing. You can talk, John. Just look at the charts, and so many charts are just rolling over. There's no other way to put it.
Let's look at the charts right now. Futures rolling over just a little bit. We're positive by 1/4% on the S&P 500. Futures slightly higher. Yields are coming in 7 basis points, 4.2568 on a US 10-year, and the euro. Haven't mentioned that this hour. Took about 3 minutes for me to do it. I apologise. The data, dreadful, dreadful. God. Euro weaker. Euro dollar here, Lisa, 108.05.
And people expecting possibly the ECB to remain on hold for just a chunk longer as they try to assess that. 1 p.m. I'm really watching this. The U.S. is planning to sell $16 billion of 20-year bonds at a time where we've seen yields climb to the highest going back 16 years. Where does the demand come from? 20 years is sort of a hairy issuance anyway, so how much demand will really perhaps set the tone in markets? After the Bell NVIDIA earnings, everyone's looking for whether they can justify a 200% gain so far this year, more than that. Can they deliver an upside surprise? Mandeep was saying, what, of 20%, which can keep this going? And at 9 p.m., it launches. It is the first primary debate of the Republican Party beginning in Milwaukee, and there are 8 candidates, former President Donald Trump not among them. Clear focus on Ron DeSantis, clear focus on Tim Scott, clear focus on issues that we haven't been talking about as much as maybe some people would like in terms of Ukraine. We heard that from Greg Valliere, as well as the deficit in Social Security.
Lisa just killed that. I mean, she could just, when Harden's off on one of her 14-week vacations, Lisa could bomb down to D.C. and just kill it.
Balance of power.
No, but you could do both. You could get up. No, Lisa, you could get up and do the 6 a.m. and then do the 6 p.m. as well.
Oh, that's so sweet.
It's so sweet.
Lisa can't wait for that. That's great. Anastasia Amoroso with us in the studio, Chief Investment Strategist over at iCapital. Anastasia, good morning to you.
Good morning. Good to see you.
Should we be worried about what's happening with discretionary spending?
I mean, there's definitely some dichotomies going on, and I do think that part of it has to do with what consumers are prioritizing. They're continuing to prioritizing services, they're continuing prioritizing, food and drinking places, and they're not so much prioritizing retail and furnishings. And I think that's part of what we're seeing in some of those retail earnings. That's really the undertone. But I can't be worried about the state of the overall consumer because when I look at the unemployment rate, it is still low. When I look at excess savings, yes, they're diminishing, but they're still kind of diminishing from a high level. And, wage growth is still running at 4.4%. So I can't be worried about the overall state of the consumer. I think some of these are idiosyncratic stories.
I love your note. that Chairman Powell will not save the day. Thank you for bringing Jackson Hole rationality in here. I would suggest he will look to August 31, and I believe it's September 31, inflation data. Will it shock us with disinflation?
The core PC numbers should continue to show disinflation, or at least sort of stagnating around this 4.5%, 4.7% level. But the one print that I am a little bit more worried about is the CPI print, which is September,
13th,
September 13th, the
Pharaoh
week
knows,
before,
I don't know.
before the Fed. But I worry about that because we've got food prices that are creeping higher, we've got energy prices that are creeping higher, and so I worry that the headline numbers are going to start rising by more than 0.2%. And per month. And the big deal about that is if you have this speed of 0.2% increases or more, we actually might start to see year-over-year headline numbers continue to rise. So, maybe the core disinflation continues, but the headline may point the other way.
Which raises a question about this from the former St. Louis Fed President Jim Bullard in an interview in the Wall Street Journal this morning, saying, I think it's turning out that the Fed's policy has been very successful, and I think that will be the buzz at Jackson Hole. I don't know what will be in the speeches, but the talk will be that this has been quite successful. Are you concerned that they're going to declare victory before they really even have the data to understand where we are in the cycle?
I don't think this is the moment to declare victory. I mean, yes, I know on the one hand you want to say, inflation is declining and we've got economic growth, but we have 5.5% interest rates and we have close to 6% GDP. I mean, that is not a soft landing economy. That is a no landing economy. That is an accelerating economy. So I think they have to take a hard look to say how restrictive are they actually being.
Given this sort of backdrop, where are you in terms of leaning into risk or backing away? We hear Liz Ann Saunders saying that she's just on the margin cautious. We hear others leaning in and adding risk, expecting there to be a recovery trade starting early next year. Where do you fall?
Well, I think you buy the pullback, and you especially buy the pullback in some of the artificial intelligence stocks. And as you know, we've been looking for some sort of consolidation and maybe draw down back to 100-day moving average levels on the S&P. But I do think you buy that because, Lisa, it goes back to the point that the Fed at this moment in time may actually not be yet restrictive, especially if they have a rethink about the so-called neutral rate, which is neither restricting the economy nor accommodating. And if that's the case, then we have the economy that might just keep going. So that's the cyclical side of it. And the thematic side of it, artificial intelligence is one of the most far-reaching opportunities. And you've got stocks in the AI beneficiary basket that are down 15, 20% from their recent peaks. I want to buy those.
You mentioned 6% GDP. Lisa, I just looked at Atlanta GDP now, 5.76%. To me, that's a complete fiction. I had a guy once in Beloit, Wisconsin, email me in anger. Said, Tom, the unemployment rate here at the time was 14%. America's not feeling a near 6% GDP economy. I mean, not even close. I mean, I really take issue with that. I love in your note, buried. I don't know why you bury it. You should put it at the top. The way you make money or not lose money in this market is to look to companies that don't rely on leverage. That's the smartest thing I've heard with a real yield where it is. What kind of companies don't use leverage?
Well, you go back to technology. You go back to tech companies that historically have not heavily relied on leverage, and you also look to private markets, for example, growth equity strategies and venture strategies that invest in things like artificial intelligence, but they don't borrow heavily to do it. They're not leveraged buyout companies, but rather they're investing equity.
John, NVIDIA, crushing debt. It's like Warner Brothers Discovery, 1.7% debt in NVIDIA.
Anastasia, thank you. It's good to see you.
Thank you.
Anastasia Amoroso there of iCapital. Here goes another one. It's Peloton. They see quarterly revenue of 580 to 600. The estimate's 647 to Tom. The estimate's 647.8. The stock is down by 18%. TK, translate this for us. When a company turns around and says we don't expect to remain free cash flow positive for the upcoming quarters, what's your response to that?
You know, it's not a 4% business. This is what's known as a loser. I, with great respect for the people that are there, I feel sorry for the sell side. We got how many analysts? Let's see. We got We got 27, make it 30 analysts following this dog. I don't know what to do with it. Talk about a zombie. Who's going to buy him? Apple?
Dog, zombie. I feel sorry for the South Side. This is how you keep in touch.
Do you know
with
how
management,
much?
TK.
Do you know how many Pelotons? Look, in my walk-up,
Anything else?
you know, we got a Peloton in one room. We got another Peloton in another room, and the only common thing with the 3 Pelotons we have is they're all gathering dust. I walk around and go, "Is anybody going to use this stuff today?"
Stock's getting hammered. To Anastasia's point, some of these stories, Lisa, would be idiosyncratic. I would suggest this is one of them.
Oh,
Elsewhere in retail, there's still a lot to talk about.
Okay, well, how many idiosyncratic stories before suddenly we have a trend? And I understand that these are the weaker players, but is this just the weaker players getting pushed out at a time where there is more discretionary kinds of behavior? Or is this something that is broader, that is people pulling back in certain corners? Peloton's its own story. I mean, let's just put it that way.
Peloton has a Peloton problem.
Yeah, what was it? Yeah. Big? Chris, what was that? Like the Mr. Big?
Oh, Sex and the City.
Sex and the City.
Are you bringing that one up again?
Well, I mean, it was like sort of the
heart attack.
That was so bad.
The heart attack.
Yeah, I think that was it marked the downfall.
Isn't that like 2.5 years ago now?
Well, but that marks the rise and fall, right? I mean, it was like the hot thing.
That was the peak.
And then, have you seen it since then?
What, Peloton or Sex and the City?
Both. Peloton. I'm talking about Peloton. I know you watch Sex and the City.
I haven't watched the new stuff.
I haven't watched the new stuff.
No.
It's just your old school.
John, Claudia Sam just put out on Twitter the photo of the lodge at Jackson Hole, and I can see your room. You've got the rock star room, 2 down from where the vice chairman sleeps. That's the one with a spider web. It's got spider web. Do you look under the bed for snakes?
It's so cute you think I'm staying at that hotel with you. If you're just tuning in, welcome to the program. On the S&P 500, futures rolling over here, just about positive by 0.1%. Joining us a little bit later, Lisa Shallard at Morgan Stanley. Just a fantastic guest, Tom. Coming up at 7:30 Eastern Time, so that conversation, 20 minutes away.
That's going to be interesting to see. We've got Lisa Shallard coming up. Dr. Weissman will join us as well from Macquarie. Back-to-back, Terry Weissman and Damian Sassauer. John, when we invented this, that's what you want. We got 30 minutes of encyclopedic knowledge on EM and the challenges of China.
Very, very cool, Tom.
Yeah, very cool.
Can I just bring you this little tidbit from Peloton? Evidently, their new expansion plan is to partner with college campuses. And they're looking to in-state Peloton bikes in college campuses in their new business
program. Which is why we're paying $75,000 for some fancy pants. School.
They're working with University of Michigan starting off. So that's sort of their way that they're trying to
issue them a slide rule, and it'll be a better world.
Well, it's just sort of interesting, sort of how they're looking to new areas of growth. That's what they're talking about.
Weren't some investment banks giving away Pelotons? Do you remember that?
Yeah.
We turn to our expert, our Peloton expert right now, Anastasia.
You get a bike.
Joins us.
You get a bike.
What do you think, Peloton? Thumb up, thumb down.
I think that might be a pandemic thing. Tom, if I had one, it might be sitting in the corner as well.
Yes, thank you.
You using that as a walker? Is that what you were doing off camera just a moment ago?
What, the Peloton?
Yeah,
that's what you got to get up. It's like Soul Cycle. I did Soul Cycle. Courtney Collins
trying to break numbers.
Courtney took me up to Soul Cycle.
You're so distracting. From New York, this is Bloomberg.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Key message of Chair Powell at Jackson Hole is going to be the policy rate is going to rest on a high plateau for a while. He's got markets about where he wants. The main message he's going to want to send is rates are going to be around current levels for a lot longer than you think.
Higher for longer, the message from Vince Reinhart there, the chief economist and macro strategist at Dreyfus and Mellon, your equity market. Well, you were grunting as I was reading.
Yeah,
it's
I was. You know,
Tom.
I'm trying to figure out the Yankees. Okay, I'm going back and forth with Doug Cass. They've lost 9 in a row. I'm upset.
Can I get to the price section?
Please.
Thank you. It's good to see you. Equities positive by 0.1% on the S&P. Yields are down by 7 basis points, TK. Your 10-year, 425.68.
And it's going to be interesting, to say the least. John, what's the data point that you see today that really matters to you? What's a single data point we got to look forward to?
Dollar strength. Dollar strength.
Yeah, 103.91 DXY. Yeah.
Really soft PMIs out of Europe, both the UK and the Eurozone.
Yeah, for everybody gets no more literature, read Jordan Rochester today. He doesn't mince words. It's at a tipping point this morning. Pay attention to that. Into Jackson Hole. Not paying attention to Jackson Hole, Anne-Marie Horton joins us now. Bloomberg debate correspondent. She nailed debate in high school, took it further in college, and now debates on balance of power. What will you focus on in balance of power is the pre-intro into the festivities in Milwaukee?
Well, I think it's going to be interesting to see how each of these individuals really try to define themselves away from the incumbent they are fighting on the stage, who will not be president, and that's the former President Donald Trump. And I don't mean so what they think about Trump, because we pretty much have a good idea of how everyone is going to deflect when it comes to, or attack when it comes to the former president, but when it comes to policies, because when you look at a latest poll over the weekend from CBS, YouGov poll, what you see is that voters are craving to hear about what these candidates have in terms of their plans for the economy, most notably inflation. So you really want to see who is going to come out. And then, of course, when you think about past debates, it's always those moments you cannot prepare for, when someone stumbles, when someone makes a gaffe, potentially when there's a bit of bickering or a modern-day version of a brawl on stage. Those kind of moments is what you want to see, and who in the next morning is going to potentially pop and get all the limelight. But we should note that that limelight that someone potentially can get Thursday morning is really going to be overshadowed within those 24 hours, because former president says he will turn himself in Fulton County, Georgia.
The former president, if you take him out of the mathematics on radio, folks, we just showed a great bar chart showing President Trump way out in front of everybody else. I'm sorry, DeSantis has a massive lead over everybody else, 19%, and the next one is 9%. I don't even know who it is. It doesn't matter. What's the DeSantis plan against Bidenomics? Is he going to come out tonight and act presidential and give us a DeSantis, I can't even say this, John, help me, a DeSantis-nomics plan?
Well, one thing, he will come out, I think, looking and trying to act as presidential as he can. He is with one of the best debate preppers this country has ever seen. When you look at the track record for this individual, this is what he's been quoted about for years, an individual who prepped in 2004 former President Bush when it comes to the debate stage, and something that we've learned from the DeSantis camp, according to reporting from our colleagues, that he has actually been doing this for months. So he has been preparing for this moment. He'll also be center stage, the way the RNC does it, because he is leading in the polls. He will be in the center. So with Donald Trump not there, DeSantis's camp is really expecting all these attacks to happen on him. So he needs to differentiate himself, not just from the former president, given the fact that he is going to be the leader in the polls, only physically present on the stage, but when it comes to Biden. So you can expect him to go after the culture wars in corporate America, saying corporate America has gone too woke, but also he will go after inflation, which I think you're going to see really all of these 8 candidates across the board go after Biden when it comes to inflation. And they're going to say that Bidenomics, what this administration calls their economic plan, has failed.
How much is the audience going to be the primary voters, and how much is it going to be the general election voters?
Well, it's interesting because, of course, you have a primary, and to get to the primary, these individuals are going to have to show that they are as far right as they can be, right up against the former president to get that primary vote. But then, if they are the ones that become the nominee, they then need to really start to move more moderate, especially when it comes to issues, if they're asked about Social Security and Medicare, if they're asked about issues like abortion. These are issues where they're going to want to make sure that they can pick off these independents in a general election. So that won't happen just yet. You're going to definitely see them really try to gear towards those primary voters, those caucus goers, because those are the ones they need to win right now.
So many strategists have told us that the only way to actually bring the deficit into check is to do something about Social Security, either by increasing the revenues for it or by cutting benefits. Have we heard any of the candidates really address in a comprehensive way, head on, what to do with those particular expenses?
About this evening, because when you look at the polls, this is what individuals want to hear about. They want to hear about the economy and inflation, but those individuals in America, those voters who are older, in their 60s and the 70s, they want to see a comprehensive plan. We have heard from some candidates who say, Mike Pence has talked about this, Governor DeSantis has talked about this, that they want to make sure that Social Security does not go insolvent. So there needs to be a plan going forward. The plan would then hit those that are younger, but they want to make sure that those that are older are protected.
I'm afraid to ask Anne-Marie, they're going to do the spin tonight. Do you go to the room? Are you in the spin room? Are you allowed to go in the spin room, or can only Joe Matthew brave the spin room?
I believe actually it's the first time that Fox is opening up the spin room to other journalists from other outlets.
Yeah.
So you can expect the spin room to be mobbed with
What
individuals.
happens in the spin room? I'm trying to think of Sir Keir in London, in the spin room of Labour politics. What happens in the spin room?
Well, they get their surrogates out there, and it's their cheerleaders, right, to say this is why our candidate did the best and try to diffuse any issues that happened potentially on stage. But I don't think people really remember what the surrogates say in the spin room. They just remember those moments on stage.
What do you think of this, Jed? This is insane.
Well, the spin room.
The spin room, the whole process is nuts.
That's a long history, Tom, doesn't it?
It used to be it was JFK and Richard Nixon, and it was about the dog and pulling the ears.
You're trying to shape the way journalists tell stories. That's what you're trying to do.
Should we do a spin room out of here?
With Peloton.
Have the guests, all of our guests there with,
It sounds like you want to go.
Oh, no, God, no.
Don't fancy it?
No, I if they ran it in black and white, that would be good. It would harken back to when it was a real debate.
Got to thank Anne-Marie. MH, thank you.
Spin room.
Down in Washington, D.C. One name to watch right now, Foot Locker. Getting absolutely hammered. The retail theme just continues. This stock is down by 31%. They've had to cut their outlook. Inventories are up. Demand softened in July. This off the back of some pretty dreadful guidance from Dick's Sporting Goods as well. Nike on a 9-day losing streak. Well, that's about to become 10 at the opening bell. That stock is negative here, Lisa, by 3.4%.
I want to just draw a comparison with Foot Locker and Dick's Sporting Goods. Like Dick's, what we saw from Foot Locker is they mentioned theft as one of the main reasons why some of their sales have disappointed, in addition to everything else. I just wonder if the physical stores that some of these companies operate are becoming liabilities in new ways that they're struggling to really get their hands around, especially because they didn't have as clear of a business model or one that was that strong beforehand. And that there's a social issue here too that's compelling to me.
Oh, without a doubt. I will be shocked if this does not come up on the debate stage later on this evening. I would be so surprised, Tom, if they don't talk about the theft that's taking place in some of these stores.
It's real. I was in with the illness I've had, I've been in a number of our pharmaceutical emporiums, and I'm sorry, to me, and people are going to think I'm an old fart. No, please. The answer is, John, you go into
What was the please for? Please don't.
Please,
you go
rewind.
into a drugstore today, and I don't know about where you live across America, but I cry when I see these plastic things with a little key thing in it.
Yeah,
it's sad.
Are you telling us that you've been off because you've been running CVS crime rings?
Yeah, no,
I'm just. Is that what you're suggesting?
Can we just lose the
doing?
Can we just lose
I can't believe
shrink?
they lock it up now.
You brought this up. You were dead on. Lose shrink.
It's theft.
It's theft.
Thank you. Yes. Terry Wiseman, Macquarie, up next.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Equities just about positive here, struggling to bounce. The S&P 500 up by 0.1%-ish on the S&P. On the Nasdaq up by a similar amount. A lift for the equity market, but just a little one. Some earnings out there, raising some concern. We'll talk about that in a second. In the bond market, 2-year, 10-year, 30-year. Let's slice up the yield curve. Your 10-year is down about 6 basis points, 4.2588. 30-year down 5 basis points to 4.35. If you've been away for summer and you're just coming back, well, yes, we've had quite a sell-off in the Treasury market, a reset, a 2-year, Tom, in and around 5%. And yesterday at the close, something like 3-4 basis points away from a new cycle high at the front end of the curve.
I'm going to go to the real yield. The 10-year real yield, 1.91% down from that shocking 2% level. And that will be, and I'm not thinking it's unspoken at Jackson Hole. I think it'll be part of the debate out there, is central bank and monetary theory in a new rate regime, and particularly a new real rate regime, going right over, John, to the R-star debate front and center.
If you'd asked me about a month ago, Tom, I would have talked about resilient economy, the tension between the progress we've made on inflation and the fact that things are still pretty robust in America. If you ask me now what the main event might be in a couple of days, global slowdown for me, what's happening in China, what's happening in Europe, very much the focus, and we'll talk about that in just a moment. Two currency pairs for you. Look out below. Sterling, the euro, weaker against the stronger dollar. Cable right now, 126.35.
Edge of Brexit.
Negative 0.75%. TK, a weaker pound off the back of some weaker data across Europe.
And I haven't looked at the technical charts, but you break support or resistance depending on the currency pair, and you're there, and we're there. DXY 103.87.
Under surveillance this morning, here's the name we want to talk about, Foot Locker, sinking in pre-market trading. The company pausing its dividend, slashing guidance for the full year. The stock also weighing on Nike as it could extend a record losing streak after falling for 9 straight days into today. Lisa, Foot Locker is down by 32% in early trading.
To $15.86. So people are not particularly full of conviction. In terms of the business model here, what is the business model at a time where people are going direct to consumer, at a time where people are shopping online, at a time where their stores are facing physical difficulties with respect to theft and with respect to the real estate footprint? There are a lot of questions here. The larger one is, are these idiosyncratic stories? Perhaps. Does it suggest something broader about a weakening in terms of consumer appetite, particularly on lower income levels? And that, I think, is something we're going to have to parse through.
Does it go beyond physical retail? Given what you've just said, Nike's down 10 straight days now.
Nike is connected to China. So all of these interconnected stories are kind of coming together. Foot Locker, more of a U.S. story, but Nike very much connected to the global slowdown that you just mentioned.
Just amazing to see some of the weakness, and these stocks get absolutely hammered in the pre-market. Odds climbing that the ECB is going to hit pause in September. Weak PMIs out of Europe, getting everybody's attention this morning. The headline reading falling further into contraction territory for the last month. Flash PMI data out of the UK also in lower than expected, with higher rates hitting demand. Tom, in Germany, I think what might get your attention would be what's happening with manufacturing in the 30s on the PMI. But I want to focus on services. The fact that services are coming down to manufacturing. Manufacturing in Europe is not coming up to services.
Does Lagarde rewrite? I believe it's a Friday or Saturday speech. I mean, what does she do? She got to rewrite it. I mean, I'm sorry. There's literally going to be sentences they're working on right now in Frankfurt. Or, I mean, the entire ECB takes off 6 weeks. I mean, that's the way they do it. But are they, at Saint-Tropez or wherever, rewriting the speech?
Oh, keep going, please. This is good. This is good. Can't wait to see if Lagarde sees you on Friday.
Hi.
Yeah.
Yeah.
Okay. Let's finish with this. UPS, the workers approving the $30 billion labor deal tentatively agreed to last month. Roughly 86% of employees voted yes. I want to know who said no.
Exactly.
A Teamsters record at UPS. The 5-year agreement will go into effect after a local Florida affiliate votes to ratify a supplemental agreement. That sort of technical stuff. Bottom line is, big deal over at UPS. Tom, big deal over at American Airlines as well. And to Lisa's point, she said this a couple of times in the last couple of days. We haven't had the strikes, we've had the pay rises.
Yeah.
Let's see if that changes.
And of course, there's a Hollywood distraction as well. I guess they're trying to move forward there, and it's based out on what I see in Twitter. It's a challenge, to say the least. What is important here at Surveillance is we like to focus for 30 minutes on a theme. Damian Sassower is scheduled to darken the door on EM and the market dynamics, and far more, John, is to speak to someone, including the frontier economy, Europe, and that would be Dr. Weissman with all of his work at Bear Stearns and now at Macquarie.
It's Harry. Good to see you. Fantastic as always. What a change over in Europe. We thought this year would be good, driven by China reopening. How important do you think the global slowdown is going to be in Jackson Hole this Friday?
Not too important, because I think that the theme of the symposium, or the conference, if you will, is not the short term. It's not the cyclical themes. The theme they've laid out is the structural changes in the global economy. And when you hear something like that, you think that the speakers are going to be directed towards talking about things that happen a year from now, 2 years from now, 3 years from now. As far as Powell's speech goes, look, the Fed could, if it wanted to, pat itself on the back. Inflation is low in the U.S. The economy looks a bit robust, at least in certain quarters, but I don't think it's time for him to do that. there are still too many hawks on the FOMC panel that are nudging him towards at least sounding as if he should be hawkish from a medium-term and long-term perspective. When you think about those narratives about the global economy that are structural and longer-term in perspective, they are things like climate change, deglobalization, demographic change, high debt in the emerging markets. Those are all things that sound inflationary. At least two of them feel like negative supply shocks. So I don't think he'll be inclined to say much about the short term and the outlook for the Fed funds rate. I think he will focus, if he sticks to the narrative of the symposium, on those longer term considerations. And that will mean that he's going to stress that it's going to be difficult to get to that last mile of inflation decline from 3% to 2%. And therefore, don't expect rates to be cut.
I look at Europe, and what we're going to hear from Powell and from Lagarde and other worthies are going to be there is, well, and I look at our start as a debate here. It's an academic debate of a full and running economy. In Europe, whether it's Eurosclerosis or something new, can there be a European R-Stard? Can you do legit economic analysis of the European experiment?
You can, and I think you can do legitimate analysis of the current cycle in Europe, this weakness that we're seeing both in manufacturing and now in the services. I think to a large extent, the manufacturing slowdown in Europe is coincident with the Chinese manufacturing slowdown. I don't think you can separate the two. Look, China had this massive slowdown in manufacturing in the second quarter. Well, look at that. Europe had a massive slowdown in manufacturing in the second quarter, too. We know those economies are connected through the German industrial complex and the export economy in Europe. So I don't think that's too much of a mystery. China and Europe are coincident. I do think, however, that this services slowdown we're seeing is also analyzable, but I think the focus has been too much on what the ECB has done with rates. It hasn't been enough on what the ECB has done with liquidity that it issues to the banks. The TLTRO program has been winding down out of the ECB for a few months now. And if you look at credit creation coming out of Europe, the extent to which banks have issued credit to the private economy, it has flatlined. And that's the reason why Europe is now seeing this slump in services.
Just to underscore this, in other words, the slowdown in services is directly related to the transmission mechanism of ECB policy, not necessarily what's going on with China, correct? Is that basically what you're saying?
That's right. But
Okay.
what I'm also saying is don't look at rates. Don't look at the deposit rate being at 3.75%. That doesn't really tell you much about what's going to happen to the European economy. Look at bank credit. Look at broader monetary aggregates. They have flatlined in nominal terms. They're actually down year on year in real terms. It's the credit economy that people don't focus enough on. And if they had been focusing on that flatlining, they would have predicted the slowdown in aggregate demand in Europe.
Is the European economy so different from the U.S. economy in terms of the rate structure and the lending structure that there is no analog to be drawn in terms of how higher rates in Europe are affecting the economy and how they will eventually trickle out in the U.S. economy and affect the economy there?
They should affect the U.S. economy the same way, but there is an important difference between the European economy and the U.S. economy, and that's as follows. The European economy is overly dependent on its banking system for the extension of credit. They really don't have non-bank lenders. They don't really have direct lending in Europe. Everyone who wants a loan ultimately has to find his way to his or her way to a bank. In the U.S., it's completely different. Now, if you were just to analyze the banking systems in Europe versus the U.S., you'd find a lot of similarities right now. You'd find that credit is contracting. You'd find that loan officers in the U.S., just as in Europe, are much less willing to extend loans. Maybe the reasons are mildly different. Maybe in the U.S. it has to do with regulatory overhang. Maybe in Europe it has to do with what the ECB has done. That's the similarity. The difference, though, is that the U.S. doesn't have to depend just on its banks. There are other sources of lending to support the startup economy, the legacy economy. We don't have that in Europe. And therefore, when bank credit contracts in Europe, you feel the effect on aggregate demand much more than you do in the U.S. And I think that's what we're seeing now. The U.S. will catch up, though.
There is a time for a surveillance audible. We will do it right now with Thierry Weissman as well. Years ago, you would publish with Emmy Sheo, David Malpass, and the rest of the clan at Bear Stearns on Latin America, and the world would stop. Argentina, do we care, or is it just the problem child of our lifetimes?
I don't care. I think it's the problem child of our lifetimes. It's not that well integrated into the global economy. Yes, it has some commodity exports, but
lose the hysteria.
Yeah, lose the hysteria on Argentina. It's not terrible, by the way, that they may have a president that's going to adopt some radical market policies in the final analysis. When you have a situation like this that hasn't been working for more than 4 decades.
Why are we scared of something new?
Why be scared of something new? Exactly. I would be much more scared of something old.
Okay, so what should the IMF do? They've been handing them out gazillions. They're going to write a check in Morocco, I assume.
The IMF should just wait. You cannot make a decision with regard to the extension of credit until you see what the political economy is. Let things simmer for a while in Argentina. Let's see what the policy agenda would be under a new president or a legacy administration, and then make a decision.
Terry, thank you. It's good to see you, as always.
Pleasure.
Terry Weissman there of Macquarie on the global economy and all the rest of it, including Argentina as well. Message of the morning, maybe of the week. This here from Thomas Thornton across the Bloomberg. The best trade in 2023 was the pair trade. Long Eli Lilly, short Foot Locker. People are taking shots versus taking walks. What do you make of that, Tom? They're taking shots, they're not taking walks. Isn't that good? Took you a while, didn't it? That's really, really good.
Classic.
That's
it's
really
sort of an
smart.
indictment of the American
But
culture.
wait, wouldn't that be
really smart?
no, that would be Diageo Foot Locker.
Diageo Foot Locker?
Yeah.
What do you mean?
Taking shots. I mean,
no. Taking shots as in like
shots.
lose weight.
Oh,
like Ozempic rather than going to the gym.
Oh, I'm not. Yeah, I tried that and it didn't work. I thought it was a different
Straight
shot.
over TK's head.
No, I'm sorry.
No. Not Diageo versus no.
Terry didn't get it.
If you've got to explain the joke, it's not as good as it. I read it. I got it straight away. I thought that was great.
I said an indictment on American culture.
Somebody said,
like,
"Are we wearing Western cowboy stuff at Jackson Hole?" I said, "One, we're not there for 2 cups of coffee." But no, we're going. It's like a business thing. It's like
What's Jackson Hole got to do with this?
No, I just my emails lighten up today with people wishing they were going to Jackson Hole. I'm like, it's really romantic.
No, don't wish that.
Yeah.
Nice.
What do you think? 42 degrees Friday morning.
Potentially, yeah. Check the weather.
Yeah, check that out.
Low 50s maybe.
With potential rain.
And then it starts to climb. No rain.
Really? I saw a couple of potential
Oh, I
raindrops.
didn't see that. We're looking at a different forecast.
I think it changes every 3 minutes.
Okay.
It's mountains.
Ah, all right. We're just tuning in. Welcome to the weather forecast and the price action as well. Equities right now positive by 0.16%. Coming up a little bit later in the next hour, Steve Rasciuto, chief economist for Mizuho Securities, Tom, on this economy going into Jackson Hole Friday.
Really important conversation. He is exquisite at the dynamics of the core GDP function. He's somebody where at the Fed they will really listen to what Rasciuto combined with Dominic Constam, what they think about the dynamics of the system. Rasciuto on GDP and Dominic doing all the different interest rate and the geometry of it.
That'll be fun. And then the She no-show with Damien Sassa of Bloomberg Intelligence. We were expecting a speech at this BRICS summit, Tom. Didn't get one. The economy's in a little bit of a tough spot. Been some suspicion about what's going on in the equity market over there, Lisa.
Here's one comment about that no-show. It's clear that Xi Jinping places a higher priority on political issues, security issues, than he does on business and the economy, which raises a question of, will they come in with the policy support if they're more concerned about other considerations? I mean, that's been one of the underpinnings of this whole weakness and the market response.
Without a doubt, Tom. Are we going to get that big policy shift? Right now, no big sign that we are.
No.
And a loss of faith, I think. A loss of faith from the international investor around the policymaker in China over the last couple of years.
Well, huge. And you see it with the devaluation of renminbi. It's tangible. Can you imagine if it continues?
Equities just about positive stateside on the S&P 500. Live from New York. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine, and we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the next episode of The Circuit. It's still almost shocking how new you still are to this sort of being famous thing.
When I do, you know, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
I think the 2-year back at basically 5%. I think that's the pain trade for a lot of the banks. At what point does the economy effectively break under the weight of real rates? I don't think we're quite there yet at 4.3%. I still think that the market's ignoring a lot of this interest rate pass-through at their own peril.
I love that I say shots, Tom, and you just think of booze.
Diageo.
Gary Goldberg,
that's where I'd go. I mean, maybe
head of US
somebody's
rate
got a better
strategy
idea.
over at TD Securities. Yeah. Shots, booze, not medication. It's a big difference there, Tom.
Some people consider it so.
Yes. So, Tom, that is medication. Futures right now on the S&P, just about positive, but fading. We're positive here by 0.1% on the S&P 500. Yields are lower by 6 basis points, 426. There's so much going on a single name basis in retail right now. Foot Locker to stand out this morning, just absolutely hammered. In the pre-market, we're negative here by 32% in early trading, Tom, as they cut their outlook going through the end of 2023.
They cut the outlook, but it's also the way of doing business. I noticed Amazon, you know, with the cloud and all that, not down nearly as much as traditional retail. And I think Lisa's dead on. This is much more than just sell-side income statement chit-chat.
It goes beyond Foot Locker, Elisa, that's for sure.
And we've seen that with Nike, and that's related to what we've seen overseas, but also Dick's Sporting Goods. Is this going to be just simply the weakest players getting punched out of the woods, getting punched out of the water at a time of higher rates? Is there something broader? Is there something that's going to be a more persistent trend? And at what point does that get people nervous versus who's gone into a Foot Locker anytime recently anyway? And does anyone use their Peloton? I mean, these are sort of the questions that people are going to be asking
I'm not sure
this
we're
morning.
the target audience, okay? I'm not sure we are. I'm not sure how often you and I go to Foot Locker is a decent indication of business
I have gone
at that company.
with my kids who want to get, you know, Air Force.
Yeah, okay.
Jordans
That's
and all
different.
That.
All right.
Although they're often like sold out. Like it's not even good customer service. That's part of the problem.
Oh, right. You let them know. You want to tell them now?
I'm good. They're having enough trouble this
morning.
morning.
We did airlines yesterday,
Best of luck.
Tom. We did airlines yesterday. Some of the customer service. It's at the gate, I find. It's not on the plane. On the plane, I think they're fantastic.
The gates are a disaster.
At the gate. Why are they so rude at the gate?
Because people are just awful. Because they're basically forced to lump together.
I think they're
and
worse
have
in
you
London.
seen this? Like the sense of like again, we talked about this yesterday. Everyone rushes to get on so they can get their overhead suitcases,
needless.
and then all of a sudden everyone's pushing and shoving, and it's like food fight.
Like Ryanair in the early 2000s.
100%.
I had a pilot tell me it's not funny. The pilots are not amused by all the luggage going on and all that. I mean, I don't know.
But why is the customer service on a plane decent, but at the gate they're just rude to you?
I do not know.
What's that
why.
about? I just don't get
to
it.
me, it's as bad in London. I find in London it's just as sketchy.
Well, we're ruder in the UK.
Zurich's great. Zurich is like a Swiss watch. They run it beautifully.
You think they're polite in Switzerland?
Yeah.
That's a new one.
You know, what's amazing...
Not my experience.
Damien Sassar's agent just looked over at me and says, "Can you get to Damien?"
No, no. I love talking about TSA pre-check.
Okay, well, Damien Sassar here in pre-check.
TSA pre-check line. Everyone's got it now, Damien. The line is like back out the terminal.
I just got it a few months ago. It's fantastic. I mean, I've never had it before. I was the one in the 7 queues just to the gate.
They're getting clear now.
So they could
Have you
be
seen
mean
that?
to me.
Clear. They're getting clear now.
I do clear.
You do clear?
Yeah,
how's that working out for you?
It's sketchy. I mean, they go my ear.
It's another good review for a company today. Sketchy.
I put my eyes, John. I put my eyes into the John, I put my eyes into the thing and they go, we'll have to do that again, sir.
Let's hope that's not a public company. Sketchy.
I'll be using it today. You know, look, what's this Francine has the Gulfstream? That's what I don't get.
Outrageous.
2 years in a row. Damian Sassower with us right now after Terry Weissman. This is really the way to do it. Damian, I want you to talk to the fancy people we will talk to at Jackson Hole. Adam Posen of the Peterson Institute scheduled the iconic Barry Eichengreen of Berkeley. They're removed from your world. What will you, as a sophisticated markets guy, say to the international relations and international economics crew at Jackson Hole?
Yeah, no, I mean, okay, I'll tell you my honest answer. My honest answer is we're moving into a multipolar world where countries are being forced to take, a side between China and the U.S. And in that environment, should those countries that can actually remain neutral command a premium from investors? So that's the big question I would have. That's the serious answer. The other answer I'd be saying is, why do we even care? Because it's all about Christine Lagarde after those PMI figures. I mean, let's get clear. Bruce Kasman called it last week. He said, forget about Powell. He's going to have 3 pages or less. This is going to be about Lagarde after the PMI. And I think he's probably right here after what we've just seen.
We'll build on that. How does Lagarde respond to how weak the data is in Europe right now?
I mean, well, I can tell you what investors are doing. They're trying to pinch strikes and short sterling and then Euro IBOR secondly. I mean, look, that's really kind of where I see the market going here. This is all about a set pause and whether or not that's the top of rates. I mean, I'm an EM guy. I'm not a Euro short sterling specialist, but I used to trade those contracts and I know what the market's doing
They
right
have
now.
Euribor, there's Shibor, there's Libor, there's like 47 Libors. It's like
Tour,
Howard
if you like.
Johnson's. Shibor, Euribor.
Well, whatever bore you have, there is a question around how high it is and what that's doing to the economy. We were just speaking with Terry Weissman about this idea that on one hand, in Europe, the weakness is coming from China, and on one hand, it's coming from higher rates, and that really transmitting into the economy. You put those two things together, doesn't that pressure the EM complex in a major way that has been sort of somewhat priced in, but not discussed to the degree that maybe it should?
Interesting. I mean, I don't know if I completely agree with that. I mean, definitely, if you just look at interest rate differentials, Euro-US should be trading at 105. And what are we at, 108 now? So, there's weakness there. Certainly, if China's PBOC isn't managing the currency, you'd probably see it at 740. That's where B of A has it. I think that's where JPM has it. It could go far higher than that. But at the end of the day, you're right. The path of least resistance is dollar higher, stronger dollar. I said that, to you guys on Monday, and I genuinely believe it. Now, for emerging markets and from a foreign investment perspective, I mean, let's look at China. China's had over the last, 2 weeks, $10.7 billion of withdrawals out of their equity market. By comparison, since 2014, emerging market local debt on a net basis has seen $50 billion removed from it. That's since 2014. And in, 2 weeks, not even, we've seen $11 billion sucked out of the Chinese equity market. So, look, foreigners are supposed to be only 4% of that market now. But, I mean, I guess at this point, positioning so light, maybe you could just see a little bit to move it. I don't know, maybe. Is China zero in your portfolios? Probably. Should it be there? I don't know. It remains to be seen.
To our portfolios, and I just, as an aside, I wanted to talk to you after the show about that investment I did in the 97-year Austrian zero coupon bond, going from 80 or 90-somethings where I closed a trade with Mr. Sassower, now enjoying a price of 5, 90 to 5 or whatever, total bombshell. Where's the opportunity right now?
Well, I mean, century bonds are interesting now, right? If you're a believer in duration, you think that rates have peaked, right? I mean, and it's not just Austria, it's, I think Petrobras has a century bond.
Yeah, I'm asking you, where's the pop if you get the rate right?
Look, I think, it's got to be treasuries. I mean, look. You're
going to go back to U.S. full faith?
I mean, I think real yields in the U.S. are sufficiently adequate. You're sufficiently compensated for the risks you're taking there, which means not that much in this environment of uncertainty. So, I like treasuries here. I mean, I like the fact that you're clipping 2% 10-year real yields. I mean, you take what the market gives you, and I think the dollar, has the wind at its back right now. So, I mean, for me, that's kind of the play. But, forget about that. Let's talk a little bit more about emerging markets, some of the things that Terry and you were just talking about, like Argentina and how no one cares. I care. The reason I care is because this is the IMF. This is the multilateral finance institution for emerging markets. And if they kind of show that they can't support, one of their biggest constituents, that's a real problem, I think, for all these other countries out there. So, I care about that. We've had elections. We mentioned in Ecuador, we've got a runoff, in Guatemala, Argentina coming up. And, these are all important, touch points that we have to focus on.
Why should the IMF be concerned about what's happening in Argentina?
$7.5 billion disbursement. That's going to be approved today, probably. At least that's what Sergio Massa, the finance minister of Argentina, believes. And then another, $2.75 billion scheduled for November after the election, maybe?
Is that our money?
$10 billion.
Whose money is that?
Oh, it's a long answer. I mean,
Well, you have 30
SDRs, we're going to
seconds.
talk about, drawing rights and all that stuff. Yeah, I mean, a lot of it is the U.S., but it's other developed market economies. It's Japan. It's the Eurozone. Everybody's kind of behind the IMF. It's not just any one party.
Do we want that body to decide political outcomes?
Well, what's the option?
I don't know the answer to that.
China, bilateral institutions who basically have different agendas. I mean, I think the IMF has done an adequate job. I wouldn't say a great job, but certainly knowing there's a backstop there for countries in crisis and in times of need is a really important thing. And I think that's how a lot of financial assets in my neck of the woods are priced.
Bloomberg Business of Sports. Speaking of options, the Yankees, even back to my youth, have never been like this. Doug Cass is medicated down in Florida. He thinks Jim Palmer should come in. The great Jim Palmer should come in and be the new manager. Are they going to blow up the Yankees this year?
Forget about the manager. I've got 2 words for you. Theo Epstein. Theo Epstein, his 2 boys are now grown. He's living up in Greenwich, Connecticut. We need to bring Theo Epstein down to the Bronx.
Give him the Red Sox love.
Give him the Red Sox love, exactly. Luciano, we got to, draw back all that. And, maybe we need to start over. Look, Aaron Boone is obviously on notice. I think Hal's going to try and make his mark. But, yeah, the Yanks don't look good. Hard knocks. Aaron Rodgers tonight. That's what we need to be focused on, the New York Jets.
You're going to watch the debate of the Jets?
What debate?
Damon, good to see you. Damon Sasser of Bloomberg Intelligence. Tom, I can confirm that Clear is a public company, if you'd like to explain.
Yes. Yeah. I'm a member of Clear. I love it. I think Clear is absolutely...
Not sketchy anymore.
Let me be clear about Clear. I love Clear. I use them. I stare at a thing. I go like this.
I see the small print running across the screen. This is not investment advice. This is not investment advice.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I don't think the Fed is done. I think we're in a higher rate for longer regime.
The inflation, the uncertainty about the Fed, the resilience of the U.S. economy, that's left us in a very different place.
Everyone would rather wait to see if something is going to come to fruition. And that's exactly what you're seeing this week.
The consumer has money. The consumer has jobs, so they're willing to spend.
There's a lot of money that's going to be getting sucked out of the system, and I think it's ongoing right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on our way to Wyoming on radio and television from New York this morning. We prepare for Chairman Powell's speech and Jackson Hole. It's going to be an interesting hour on this as well. John, I just think we got to do a data check here. And the per capita income in Jackson Hole, Jackson Hole, $318,297 is the per person per body income in Jackson Hole. 69, sort of like the surveillance team, 69% of income comes from investments. This is a fantasy land we're flying out to.
Things are pretty good if you've got loads of money. For other people right now, not so much. So we can talk about a couple of names. We've had some warnings in the last week from retail. Foot Locker this morning, cutting the outlook, the stock getting hammered. Same thing from Dick's Sporting Goods in the last 24 hours. Some warnings from Macy's about delinquencies. Lisa talking about that. Last week, student loan repayments are going to restart later on this year. And apparently, according to Walmart and Target, Tom, that's going to hurt. This Friday for Chairman Powell is about the tension between the progress they've made on inflation. And they have made some progress.
Yes.
But the fact that mission is not complete, because at the moment, this economy has been far more resilient than they thought it would be. It's the tension between those two things and whether they need to go further or maintain rates higher for longer that we'll all be focused on.
But to me, the heart of the matter, and I think Powell's actually been pretty good about the social aspect of the dialogue, is the haves and the have-nots. We are going to Happy Land, the absolute ground zero of the wealthy in America, and we have to witness the retail numbers you're talking about. Lisa, I'm sorry, half of America is flat on its back with a 5% GDP statistic.
I take your point, which is the reason why it really stood out to me that the former St. Louis Fed president, Jim Bullard, said this in a Wall Street Journal article. I think it's turning out that the Fed's policy has been very successful, and I think that will be the buzz at Jackson Hole. He went on to say he doesn't think this is necessarily going to be reflected in the speeches. It's not a very good look to say victory, but at the same time, that's going to be the scuttlebutt. This, to me, is a question. Is it too soon? And this is what everyone keeps talking about, the long and variable lags, which we laugh about, because how long, how variable, what does this mean?
Super long.
Super long or super short, whatever you want to call it. Whatever you want to say, it is clear that rates are not transmitting to the U.S. economy as quickly as people had previously thought. And so it raises a question, will they ever? And then what does that look like?
Okay, I've got in my briefcase my book of the summer, Olivier Blanchard's monograph on our start. It's on where are we going to settle out? John, what are we going to hear at Jackson Hole about the new 2.0%? I think we're going to hear a lot about it.
The new long dot, a high neutral rate.
Yeah,
John Williams, the former New York Fed president, poured some cold water over that, Tom. And I think to Chairman Powell to come out this Friday and maybe separate himself from New York Fed President John Williams would be a pretty big ask, wouldn't it?
Yes.
It would be a big ask. Yeah. So let's see. Let's wait and see if we hear anything on that. I think in the last 24 hours, to some extent, relatively speaking to where we were a week ago, much bigger attention now on President Lagarde of the ECB this coming Friday, off the back of some pretty dreadful data out of Europe, off the back of a weaker China. And Tom, if we took the US economy out of it, let's take the US economy out of it. It's pretty robust, resilient, all of that stuff. Take it out of it. Just focus on China. China at the moment, not great. Policymakers struggling to respond to it. Europe, sub 50 PMIs, basically in contraction. And inflation's still a problem. Even with that, things are much, much harder.
I'm going to go where you were 2 hours ago, John. The euro, we're on the 107 handle. Watch 108.12 on a weak euro.
Yeah, and potentially 105, according to Nomura's Jordan Rochester. He seems to have more confidence, though, Tom, in a weaker pound story. The pound at the moment, 126.29. He's looking for 122. So $1 stronger here. Bond market rallying, taking some of that yield back. TK, we're down 5 basis points, 427.26, and equities just about positive by 0.2%.
Just had a wonderful feeling. Lisa Shallot to take over for James Gorman, I think it would work.
Lisa Shallot
I'm sorry, I think it would work. The Chief Investment Officer at Morgan Stanley Wealth Management joins us right now. Your worst nightmare, Ms. Shallot, no question about that. Tell me what you're hearing from Morgan Stanley investors. I don't want to know about, the research department or what banking's doing, the land of Gorman. What are you hearing from your customers?
Yeah, so this is really interesting, Tom. Our clients have been, quite frankly, pretty willing to watch the quote-unquote sideshow of markets this year and take advantage of what, for many of them, are the best fixed income yields in 10 to 15 years. And with so many things and so many cross currents that, quite frankly, don't hew to traditional or recent models of how Fed tightening works, a lot of this has been viewed by our clients from the sidelines as they clip coupons.
Lisa, the real yield is up at a level which most adults that we talked to said it would never get to. Do you change your portfolio allocation with a 10-year real yield touching 2%, now 1.92%?
Now, our advice has certainly been to do that. We believe real yields at these levels make fixed income particularly attractive, and the stock market is still not fully processing the reality that these real rates at these levels, if they persist and they prove not to be a momentary dislocation of liquidity in markets, if they are truly emblematic, as you mentioned earlier, of a potentially higher R star or a Fed that is exceedingly patient, that has major implications for the valuation of long duration growth stocks. And this is one of the conversations that we're having with folks. It's kind of, Finance 101, reminding them that the discount rates matter when you're thinking about the cash flows even of the Magnificent Seven.
Lisa, there's one thing to talk about clipping coupons at a time where growth is decelerating. It's another when just looking at the GDP Now forecast from the Atlanta Fed, as Tom was mentioning earlier, it's nearly 5.8%. It's reaccelerating. And you can say hocus pocus, there are all sorts of other things that it's not accounting for yet, et cetera. Still, there has been this incredible growth, which goes against the normal thought that there will be a slowdown as a result of these high yields. How do you explain that to clients and say, no, this reacceleration can't last? No, look beneath the hood. What are you pointing to really show that it's not sustainable?
Well, I think we're trying to talk a lot about the extent to which this has been a combination of balance sheet resilience combined with excess savings across the private sector, both for corporates and for households, and really just doing the math and saying, look, at a certain point, that excess savings that was delivered to the household sector at the peak of COVID, which approximated $2 trillion, is now down by our best guesses to something around $375 billion is left. Again, not saying that that's nothing, but it is attriting. And that you put that together with some of the other factors here, as have been discussed, whether it's higher oil prices, the demands of student loan payments, et cetera, and the consumer will start to face headwinds in our humble opinion. On the other side of the ledger, for corporates, certainly the sum of the refi wall on some of this corporate debt, we believe is going to start to show itself in 2024, and you're going to start to get some of these cracks in the credit markets, alerting people to the cost of capital, and that maybe the capital spending boom that we've seen begins to slow a bit as that interest rate sensitivity does finally kick in over the next 12 months.
How surprised have you been? How frustrated have you been, Lisa, that the thesis hasn't really played out this year?
Extraordinarily so. Look, I think that we tend to model things in two dimensions. One are our economic models, and secondly, our market models. And what's been pretty extraordinary is both types of models are failing in the current environment. The macroeconomic models, things like indices of leading economic indicators, some of the manufacturing PMI-oriented data that historically have pointed to material deterioration in corporate profits, has not really played out. On the market side, things like the real rate, which typically is inversely correlated with stock prices, has just not had the efficacy. We've seen, price earnings multiples really expand in the face of rising real rates. That's not a typical correlation. So this has been an extraordinary year. If you tend to be pretty, data and framework driven in your recommendations, as our team historically has been. Now, that doesn't excuse, trying to do the homework for, what we missed. And as, we've tried to talk about, we really missed the extent to which this interest rate insensitivity would persist, and the extent to which household balance sheets and corporate balance sheets have thus far been immunized. Their spending patterns have been immunized from these higher interest rates.
Lisa, you weren't alone, that's for sure. Lisa Shallett of Morgan Stanley. Lisa, thank you for the update there from Morgan Stanley Investment Management. TK, hasn't that been a story? One person's complacency, another person's resilience. Which one is it?
Which one is it? I think Anastasia Amoroso nailed it. Is you got to look at the three accounting statements rather, and the key attribute here, given Lisa Shallett's discussion of real rate dynamics, is leverage, 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 leverage. That's the first. You go to WACC, John. I don't know if you knew this. It's a terminal function, weighted average cost of capital.
Thank
informative.
you.
Do you want to own things now with a lot of debt? Like. Look at Hollywood and entertainment, just as one example. That's where Amoroso was coming on this.
Is he great refinancing that never was, but might be next year? If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.2%. Coming up in about 18 minutes from now, Steve Risciuto of Mizuho Securities looking ahead to Chairman Powell in Jackson Hole, Wyoming on Friday. Before we get there, after the close, we will have numbers from NVIDIA. Looking ahead to all of that, Jim Karen of Morgan Stanley in the next hour on Bloomberg TV, alongside David Leibovitz of JP Morgan, Nadia Lovell of UBS. And we'll ask that question at the very top of the hour. Complacency, Lisa, or resilience?
It's two sides of the same coin, at least. Where are we in this moment? It always looks like a soft landing when it is about to turn into a hard landing. That's what we were hearing from JP Morgan earlier this week. At a certain point, though, what data are we tracking? And this is my frustration with data dependency. I know you share this. At a certain level, are they going to try to declare victory in Jackson Hole, even just on the margins, not in the speeches, because it's a bad look? But, or are they going to really say, hold on a second, there's something else going on here. Take a look at Foot Locker. This is concerning to us. Are they going to be paying attention to that?
There's a data point this morning for you. I think relative to last year, they're in a much better place.
Yes.
And they deserve to feel much better about the situation. Whether they declare victory, TK, that's a stretch at this point, going into September.
It's not. There's a humility to Jackson Hole. Seriously, folks, we make jokes about it, but there's some serious academics going on here. In debate, it really gets heated. They really get going in the meeting. McKee's in the meeting. They won't let me in. I tried to sneak in once when I wore a bear costume. Tried to sneak in one year, I didn't get in. And Bowder went mental. Willem Bowder at Citigroup went absolutely mental.
Because you were in a bear suit?
Because you could get in.
That was part of it, but they won't let me in.
Why did William go nuts?
I can't remember what the paper was, but they really get going on this. There's like serious debates here. To me, it's over our start. It's like, where do they set?
This is really selling it
5
to the
years
people.
out, 10 years. I am. I'm selling
what a promo. Going into
I'm going
Friday.
fishing.
You're going fishing.
No, you're
Matt
not.
Lloyd, Western River Anglers. I'm going fishing.
Let's get a video of that. All right.
slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
It is a weaker China that we've seen. And of course, Europe is more exposed to China than the US. So definitely part of the slowdown picture. And I would say generally a theme of divergence of the US versus the rest of the world. I think what we're seeing in Europe is the impact of tight monetary policy. The transmission has been much faster or more powerful than in the US.
Virginie Mazeneuve at Allianz and with massive Pacific Rim cred. She was really quite good about the synthesis of China into all north and, of course, down south to Australia on the Pacific Rim and the oddities, the confusion right now that we see there. Here at 8:17 a.m., we're doing a number of things. We're looking at really ugly retail America. We're looking at some difficult European numbers. We're on watch for 107 euro, 108.08, 1.0808 weaker euro today. We have our eyes on India, which was a non-story until X number of days ago when a Russian space probe crashed on the moon. Don't know much about that, but what we do know is India now will make the go. I believe we've got an image on radio. It is a textbook image of what you see in a control room, and this in India as we are 20 minutes away from that. Lisa Bramwitz, our satellite expert, will bring us coverage on this.
We're all looking forward to that, including me.
We're looking forward to this, and it's some wonderful history here because they look to the far side of the moon. Lisa, it's good to talk to Henrietta. Why don't you bring her in because she's expert on the far side of the Capitol.
All right, well, fine. Let's start there. Henrietta Trey's Director of Economic Policy Research at Veda Partners, and we've been talking all day about the debate that happens at 9 p.m. Eastern of the Republican primary candidates. But there is a larger question right now at a time where we are hearing about Gina Raimondo going to China and a question of the rearranging of the global sphere. And I'm just wondering, from all of the rhetoric that we've heard over the past 24 hours, really criticizing China by the U.S. about the lack of transparency, et cetera, is there a clear message right now coming from the U.S. administration on exactly what they want this relationship to look like?
I think the message is getting starker, and while the Biden administration is doing its level best to have these cabinet level secretaries be going over to China throughout this year and maintain that there is a dialogue happening at a high level that would prevent, a trade war from escalating into something more aggressive, you are simultaneously now starting to see the Republican presidential candidates enter the fray on the China discussion more aggressively. And I think it has to be said, former President Trump yesterday having that bombshell report in the news that he is reconsidering and plans to repropose what was a 2016 idea of a border adjustment tax that effectively says anything coming in from China gets taxed with a 10-20% tariff rate, which is effectively a tax on durable goods. Big box retailers end up going sort of ballistic whenever this gets proposed, as they did in 2016. But it's a $1 trillion revenue raiser that when we deal with tax reform in 2025 is going to have to come up. So I think the Biden administration's approach to China is already being influenced and is going to be wrapped into the Republican presidential candidates' plans, which is to be very aggressive towards China and indeed the rest of the world. The border adjustment tax is not just facing China, but any nation that does trade with the United States.
Just building on that, this idea that the party line is to be as aggressive as you can on China. We are expecting to hear that from the candidates tonight at the Republican primary debate. What is the distinction between candidates? Is it sort of hard and harder in terms of the lines that they want to draw? What are some of the contours of where they're going to draw distinction from the other candidates?
On the trade front, I think there's nowhere to go but more aggressive. Domestic onshoring, imposition of tariffs. Anti-China sentiment in the United States is at its highest that we've ever documented, according to Gallup polling. The only groups that are from the sort of traditional Republican platform, which used to believe in something called free trade and is now something called fair trade, which apparently requires tariffs to even out the uneven playing field that the Republican candidates see. There's really no limit to how aggressive you can get on China. And I would not want to be the Republican candidate saying, hey, maybe trade with China is a good idea. They'll just get pilloried by anyone who's polling higher than them, including Trump.
Henry, I don't have this as direct news, but I think it's anecdote with imagery that in some form, 5 drones took out 5 major jets, bombers, whatever, of Russia overnight. That brings an immediacy and imagery of this war in Ukraine, whatever the news may end up being. How do they address a war in Ukraine, which I would suggest does not engage the American audience?
I mean, the Republican Party in particular is specifically bifurcated on this issue. There are some candidates, I'm sorry, not really candidates, but there are some Republicans in mostly the United States Senate. I would say Mitch McConnell is the most preeminent actor there, who are strong advocates for continued aid to Ukraine. They will take the White House's $10 billion supplemental emergency request for Ukraine and probably plus it up to 15 or so, as we've seen them do in the past. But then you have the presidential candidates who are pretty split. Ramaswamy, I would say, is probably the leading candidate, along with President Trump, who would say, maybe let's question whether or not this is a situation we need to be engaged in at all. We're more worried about federal spending. Let's strip this out of any supplemental request.
Okay, but I made a joke earlier about the far side of the Capitol as we wait for India coverage here in a number of minutes as they attempt to land a craft on the moon. Henrietta, let's try to land a craft in Congress right now, and that's the culture war. Is this debate about the economy stupid, or is it about culture stupid in America?
It's really unbelievable. I was just thinking about this yesterday. Then Majority Leader Mitch McConnell gave Republicans the biggest Christmas present I've ever could have imagined. Trillions of dollars in tax cuts that expire the year after the president is elected, the next president. This campaign should be exclusively about tax policy, federal interest rate policy, all the individual tax brackets expiring. And you can't even see the Christmas present because Donald Trump and abortion are blocking out the entire tree, let alone that present. So I think that in a alternate universe, Republicans are talking exclusively about tax policy and economic policy right now, which would be a boon to them going into an inflationary environment where President Biden has struggled to get his Biden economics message across. And instead, we're talking about abortion because it's on every docket, particularly across the South, next in Virginia.
And this raises a question about what the gravity is going to be after today and how much it's going to pull away from just a shrug of the shoulders and a suggestion that President Biden will get reelected. How much concern is there in the Democratic Party about really galvanizing that campaign at a time where donations are flagging and a lot of enthusiasm is as well?
I mean, all you need to do is look at the turnout we've seen in Ohio and Kansas, and we will see, I suspect, in Virginia in November, and again in Ohio in November. The voters are flocking to the polls when it actually counts. I heard an incredible note. It's basically, people will say that the economy is their number one issue, but then they go to pull the lever in the voting booth and they say, oh, I vote for this guy because of his position on abortion. I think that's what you're seeing in the middle of August, and that's got staying power.
Henrietta Trace, please watch the debates because I'm going to be with Damian Sassower watching the New York Jets. Henrietta Trace, thank you so much, with Veda Partners. Lisa, there is Eli Lilly of Indiana. I can't explain the pharmaceutical expert of the troops from Indianapolis. And years before that, literally the cash founders of Washington University of St. Louis was Mallinckrodt. This is one of America's venerable names in pharmaceuticals until I'm going to just quickly eyeball 15 years ago, where this company blew up with opioids. And that's what this is about. Mallinckrodt of St. Louis, in one of the 47 spin-offs from Tyco and Covidien, declares a second bankruptcy this morning. They did so 3 years ago. I don't know the particulars on this other than to say, Lisa, it's one of the great venerable names of pharmaceutical science in America, buried within all the debate and litigation of opioids.
Yeah, they're paying their final payment of $250 million to the opioid trust, and in the process, wiping out a bunch of their debt in this bankruptcy.
Coming up, Michael McKee. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Bloomberg surveillance, we'll get it right. Good morning, everyone. Jonathan Farrell, Lisa Bramlett, and Tom Keene. We're on our way to Jackson Hole here in a number of hours. John Farrell preparing for the 9 o'clock hour. We have so much going on. Stephen Rasciuto will join us in Mizzou. This is a critical review of the American economy. We're going to go out and see Wonder Boy waking up at the Pioneer Grill in Jackson Hole. That would be Michael McKee leading our coverage. And also we have a landing of a spacecraft in India right now. Lisa, give me the image, please. Mr. Modi here, I believe, going to talk. And, we're a little bit vague on here. There's a count up clock as they descend. And what's amazing here, Lisa, is this is to the south, where we did not go with Apollo 11.
And you put it really well earlier that we wouldn't be talking about this as much if the Russian lunar landing on the South Pole a couple days ago didn't pan out. They crashed, and this one is slated to be the very first to land here. What's interesting to me is this comes at a time where India is really ascendant and is sort of throwing around its heft as an independent player at a time of a bipolar or multipolar geopolitical world. And you see that taking place with this question of, are they going to go with Russia and China, or are they going to move to the West? Are they going to remain independent? For them to be displaying this kind of space-related kind of exploration highlights their preeminence in the new way.
And to set this apart, folks, with the history here of there's water in the bottom of the moon. We learned this from Ranger-like spacecraft that crashed into the moon. And so now, like China, like America, we're trying to land on the far side of the moon. And for those of us in our youth, this was a huge deal. Lisa, this goes back to October of 1959, which is frankly 2 years after Sputnik, and it was maybe even more amazing than Sputnik. The Soviets were on the far side of the moon, and we weren't. And that resounded through American aerospace science.
And Pink Floyd was on the dark side of the moon. There is a question going forward about whether, we do find water and the fight over that. And that has been something that people are looking for as well.
Yeah, it's just great, folks. This is when you get Chicago aerospace in there when we're quoting Pink Floyd.
Well, I mean, come on.
As the Indians got it
Everyone
done.
was
We'll
thinking.
continue to follow India as they create some scientific history here right now. Creating history right now, Pioneer Grill open for 32 minutes out at Jackson Hole, which means Michael McKee, leading our coverage at Jackson Hole, is well fed as well. He greets us in the chill of Jackson Hole. Michael, I want to go to that moment that we'll all see where Powell, Ueda, newly minted at Japan, Broadbent in for Bailey, and of course Lagarde speaking as well. They're going to wander out and point to the scenery behind you. What are they going to be thinking about? What is the common ground of four central bankers as the Kansas City Fed meets to greet?
Well, I think there's two things, Tom. The first is they're going to look at these mountains behind me and they're going to say, wow, it's real. It is so beautiful. And then they're going to think about what are we going to do to keep inflation down in the three countries that have inflation problems, and what are we going to do to keep inflation up in Japan? Those are their main goals going forward. And while all of that does seem to be happening as the central bankers would like it to, they can't really explain all the reasons why. And so this conference may be able to provide some grounding for the central banks as they try to figure out what their moves in the coming years are going to be.
I look, Mike McKee, at the niceties of this in the Kansas City Fed for our international audience as well. Can you explain the transfer of power at Kansas City? You and I were with Esther George last year in the grill with a baby puppy pivot, and now we have Schmid of Kansas City. Tell me about Schmid of Kansas City.
Well, he started, as the tradition at the Kansas City Fed seems to be, as a bank examiner, not at the Fed, but at the FDIC, but worked his way up in banking, ran a couple of banks, did a stint as CEO of Mutual of Omaha, so we will get Marlon Perkins out here to find us a moose, and then ended up running a family bank in Dallas. So he's got a banking background, same as Esther George and same as her predecessor, Tom Honig, so the bank stays consistent in that. As for his monetary policy, we have no idea at this point. He's only just started on Monday.
Michael McKee from the far side of the Tetons. And now we go to India and I believe a successful landing of their spacecraft searching for water at the bottom of the moon, very, very distant from the Sea of Tranquility that we saw, what is it, Lisa? Help me here, 50 years ago, 50 plus years ago. Moments ago, Lisa, Mr. Modi waving the India flag, a proud moment for Indian science.
And this really pushes forward exploration as the hunt for water in space is important. I can't help you with 50 years ago. I can tell you that this is going to be interestingly going forward. Well, it's just, I mean, honestly, you're like, you can help me out there on the history of exploration. Come on. Really, you think that I'm going to just know? No, don't know everything.
We'll go from the Mr. Bramo there, putting me in my place, to the elder. Constam's even a kid here to you, with Dr. Constam holding court at Mizuho Securities, is Stephen Rasciuto, the U.S. chief economist. What's the common ground? I'm talking about common ground of four central bankers. Right now, what's the common ground of the brilliant Rasciuto Constam research at Mizuho? What do you both agree on?
Well, I mean, I think the answer is very, very simple, is that, you know, there is a dynamic trade-off going on between the global political forces and the global deflation or disinflationary forces versus the cyclical local inflationary forces that several of the individual countries are experiencing. And it's this battle that's being reflected in the yield curve. You know, the reason why long-term rates can't mount a sustained upward movement is everyone looks at it and says, okay, eventually the Fed's going to be successful at holding down inflation, so how far do we need to push? But by the same token, there's global deflationary forces out there that's pulling down long-term rates. At the front end of the curve, it's all about domestic cyclical inflation stories, and that's pushing the curve. So the curve is in this inverted standpoint. It's been here for over a year, and people keep on expecting the curve to shift back to a more normal position. And the reality is it's probably just not going to happen.
I'm talking on camera with smart people like S.A. Adam Posen, the Peterson Institute. I'm talking off camera with all the officials that don't want to talk to me on camera. Are they working out of the textbooks you used in school, or are they making it up at Jackson Hole internationally?
Well, they should be working out of the textbooks. They should be actually going back to the older textbooks, the Keynesian textbooks, because the reality is we learned from COVID that Keynesian economics was the right brand of economics, and we've gotten the response we expected from a Keynesian stimulus. And therefore, a lot of the Nouvelle discussion is kind of should be put to the wayside. In fact, one of the things that worries the most that I hear from the Federal Reserve officials is this idea of as inflation comes down, real rates go up, and therefore the tightening gets greater. The reality is corporate CEOs do not make decisions on after the fact real interest rates. They make decisions based on what they expect nominal interest rates to be. And that nominal interest rate assumes an assumption for real returns and an inflation expectation. And if those nominal interest rates are rising, that's a bigger problem than them looking back and saying, oh, well, real rates were higher.
All right, let's put this all together and raise a question about the soft landing narrative that seems to now be the consensus on Wall Street. It seems as though this has become a commonplace idea, even though it's been elusive historically. I see you laughing. Are you seeing material cracks that challenge the idea of this that people are ignoring?
No, I don't see any material cracks right now, but I think the reality you have to understand is that any recessionary tendency will wind up being a hard landing. You know, there are differences between crashes, credit crunches, and there are differences between recessions. And this is going to have to be an inflation recession. And that's the result. And that's not necessarily a soft landing. A soft landing is this vague concept where you bring the economy back to trend growth and inflation comes back in that direction as well. That's not going to happen with a labor market as tight as we have today. And it's going to be hard to get inflation to go from 4% to 2%. A lot harder than it was to go from 9 to 4.
So we're talking this morning about Foot Locker, about Dick's Sporting Goods, about some of the results in retailers that have struggled in the past and that are now seeing that kind of come to a fore. And we're raising a question, is this idiosyncratic stories of management structures and business models that have become less relevant, or is this something broader about consumer spending? From your view, not to go into the companies themselves, but what do you think it is?
No, there's a lot of idiosyncratic risk. I mean, keep in mind how long the expansion was prior to the COVID meltdown, and then the nature of the COVID restructuring and the rebalancing or the reacceleration really has papered over a lot of problems for a very long period of time. And they all have to come home to roost. And this is the idea that a recession is somewhat therapeutic if it's not a credit crunch. And we kind of need that in this environment.
You are acclaimed, and I'm going to go to Olivia Blanchard's study of R-starred and where we are. And the one phrase that permeates, and this is the humility of Blanchard's work, is other factors. Yeah. He says there's things out there we don't know. You own the high ground on this. What are the other factors that make this R-starred certitude a mystery?
The real issue is when you look at balance sheets, which we don't do a lot of. We don't look at balance sheets and try to assess where we are. We look at things like financial stress measures, which, to be honest with you, we play games with because they're statistically created out of indices that we see published in markets. The reality is when you get to look at the underlying balance sheets of companies and you look at them at a macro level, balance sheets are extraordinarily healthy. And this is why when you looked at Silicon Valley and so forth, you could actually back away from that having been a credit crunch because the underlying balance sheet of the banking industry was very healthy.
Just to sort of pull this all together, what is an inflationary recession? What is an inflation recession, what you just said?
Well, the difference between an inflation recession and a credit recession is basically the interest rate increases and the inversion of the curve slow the economy to bring down inflation. In a credit crunch, what happens is the inverted curve causes a credit crunch that then causes a recession. So the Federal Reserve has to slow the economy. You can't get the economy to slow and get inflation to come down to target unless you're going to create an excess in the labor market or some excess in the labor market. That's what they have to accomplish. You can only do that by having GDP contract. That's a recession. The reality from a credit crunch standpoint is the credit crunch causes the recession. And that's what 1990 was, that was what 2000 was, that was 2007 was, and the reality is that's what COVID was, because COVID was a massive corporate balance sheet problem and household balance sheet problem. And that's why they required subsidy levels of interest rates.
Steve Risciuto, thank you so much with Mizuho. A lot of breaking news going on right now. We have a correction, this is on Mallinckrodt, and it's a subtle correction because there's loads of headlines out about their restructuring and bankruptcy over 3 years. But to be clear here, Lisa, they have not filed for bankruptcy. They have a scheduled filing for bankruptcy in the coming days.
We're clarifying some of the timing as they try to figure this out and work through this excess from the legal settlements and just how much they had to pay.
Some confusion over my inept coverage of the landing of the Indian spacecraft to the south of the moon. It's not like Ranger where it crashes in. This is a landing, like I'll say a lunar module that we remember from Apollo. But then the idea is to have a rover, which I believe is 60 pounds. It's like a teensweens rover going down. I guess it goes down the ramp like in, you know, like a Disney movie. It goes down the ramp and then it goes out in the surface and looks for water.
I'm actually really excited about this, but I love science fiction. I'm revealing way too much.
This is not fiction. This is like reality.
I know. It's so cool. And water is where life is, and that's the potential exploration. Although I imagine there's some other reasons.
They're in my ear. Enough of the Bill Nye the Science Guy stuff. Do a data check. The VIX 17.00. Standard & Poor's up 0.1%.
I like Bill Nye the Science Guy. You could keep going.
I got my Bill Nye bow tie.
Oh, you should wear it more often.
It's
I'm
in there.
totally
I got
a fan.
470 bow ties in the closet.
Complete fan.
It's a walk-in closet. And in the answer, there's my Bill Nye. You know, he gave it to me.
But you have a walk-in bow tie closet?
I have a walk-in bow tie closet.
And do you have like sport bow ties?
No, I have
like,
you know, 3, and then this is we'll see Lagarde out in Jackson Hole, and there's 3 big hooks that hold about 100 of the bow ties, and one on this side is gifts. Wonderful, generous people. I got one from Constant, but not Risciuto. I don't know what that's about. And there's another side, which is stuff that's like from the family, which I've never worn.
Yeah.
And then there's in the middle the Hermes bow ties, because I wear Hermes bow ties.
How do you choose? Is it sort of like roulette? Do you have a big wheel?
You choose at 3 a.m., it's in the dark, and you just pick one.
Oh.
What am I wearing today? I don't even know.
A lovely sort of very thin plaid bow tie.
Oh,
you
yeah.
This
is I need tenure bow tie. You wear this when you need tenure.
So this is our retail conversation of the day as we focus on potential issues in the retailers. But this is sort of the question, you know, I mean, are we seeing people, you know, not buy bow ties as much?
Well, you mentioned, you know, Hermes and something fancy like that. It is about this huge bifurcation in society. That'll be the theme of Jackson Hole. Michael McKee out front, setting up with our team for our complete coverage. Ruwert, there's a shot, and I see Joe Weisenthal and Tracy Alloway. They're halfway up the call right now. Weisenthal's on oxygen.
Oh, that looks beautiful and cold.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. Can't seem to hold on to the gains as the session grows older. We do see the S&P futures just dip just a touch as we assess whether the slowdown can. Oh, actually, now they are up a tenth of a percent. We're looking at a question around how much we can gain resilience at yields where they are. Yields trying to go lower and coming back as the session grows on. And frankly, we saw this yesterday too, Tom. Yesterday, we did see initially a bit of a bid into treasuries, and it completely faded by the end of the day. And I wonder if that's sort of the gravitational force right now in the bond market.
Yeah, but help me here. Are we Jackson Hole dependent or are we NVIDIA dependent? I would suggest right now NVIDIA is more important.
I think that right now the expectation is for Jay Powell to say absolutely nothing of import because he has no incentive to, and NVIDIA actually will give us projections, which is a reason why. I do think it's important to look at some of these single name movers right now. I think it's important to take a look at the retail names that we've been talking about throughout the morning. We've been talking about Foot Locker. It's taking a disproportionate amount of airtime. People are saying, why do you care about Foot Locker? Everyone kind of wrote them off. But the fact that they cut earnings and their expectations for earnings so significantly after already seeing a deteriorating business outlook really has gotten people concerned. Those shares have lost about a third of their value so far in pre-market trading.
I did not realize that that's hammered. Wow.
It's a massive move, and we're talking about adjusted EPS expectations this year for the full year of $1.30 to $1.50 from $2 to $2.25. So significantly coming in, sales coming in, talking about theft. We've heard this from a number of retailers, including Dick's Sporting Goods. Is it just Foot Locker, or is it something bigger?
Paula Jews out moments ago at Citigroup. He's really wonderful. I hope I'm pronouncing that right. You know, I'm probably butchering it. Paula Jews with Abercrombie and Fitch, killing it. Against everybody else.
We're going to get
there. He calls
there.
it a blowout quarter.
We're going to get there. So that's the reason that people are wondering, is this idiosyncratic or not? Nike, before we get there, also poised for a 10th
What are you, all
straight
retail
loss.
today?
Yes, I'm all retail.
You're all
because we want to
retail,
know,
okay.
Is it idiosyncratic or not? And that's the question, which is you pointed to Abercrombie and Fitch. They are soaring after boosting full year outlook. And is this idiosyncratic? Because they did adjust some of their Hollister brand, their teen brand. I would say, you know, some people might buy it who aren't teens, but you know, there is this brand that they are reset and they're trying to take actions to recalibrate, and they did have some rocky periods earlier. How much is this a story by story, and how much can we draw conclusions at a time where you've said this, the gravity's coming onto Earth. The winners are going to win, the losers are going to lose.
Yeah, but the difference here on Fifth Avenue is my kids are lined up outside Uniqlo trying to, get something, that they saw in some fashion mag, some foreign fashion mag. Your kids are lined up outside Abercrombie and Fitch. You got to refi the house to get out of Abercrombie and Fitch, right? It's expensive.
I don't know because my kids aren't lined up outside Abercrombie and Fitch, but I will say, you have different price points. It's not exactly luxury. It's just that the winners can still win. I think that's the point,
Right.
and why it's so difficult to come up with a narrative in this market, because you still are seeing discretionary spending for certain things and not for others.
And now he's Segui this morning towards Jackson Hole, where everything today is an angle on Jackson Hole. This will top them all. Long ago and far away, David Blanchflower of Dartmouth College and the Bank of England was out there. He went on a hike. Blanchflower got halfway up the damn mountain and couldn't get down. They had to go do a rescue effort. Mike McKee rescued Blanchflower off the cliff. Someone with knowledge of this is someone who's never been up the famed Dartmouth Skiway, legendary. This is what you do in the Dartmouth bubble. You go ski all winter. Ed Harrison with us here, Edward Harrison. Dartmouth, it was like religion. You had to have a certain beverage of your choice and go out to the skiway. You never really did it, but I mean, this used to be like religion, right?
Exactly, and I bucked the trend by being there for 4 winters and never once setting a foot on the ski slopes.
That would be smart. Your parents end up at the Dartmouth Lodge there on the green as you're in the hospital with a broken leg. Let's talk about the broken leg of the American economy right now. Lisa's been going all day on this. Retail shows a grim consumer. What does Scott Landman and the team say in Washington?
Well, I think that I'm thinking Anna Wong in particular, and she's saying that she's still looking for end of 2023, early 2024 recession, and we're seeing the incipient signs of some distress potentially there. I think the one thing to look at is GDP now, which is at 5.8%. The next version is coming out tomorrow. This is ahead of Jackson Hole. So it'll be interesting to see whether, with the surprises, the upside surprises that we're getting in the economic indicators, whether or not we start to roll off.
How important is it to you that we have seen bonds sell off into the close? This idea that in general, you do have people who are interested in buying the dip. Maybe at the beginning of the day, but by the end of the day, they're like, no, we're done. I mean, is that important to you?
Well, I think the question is the fundamentals versus the technicals, because the technicals, Ed Bolingbrook from my group, he has a post out today saying that we are short across the curve at every single maturity, both in the U.S. and in Europe. And so what that says is that the technical factors are moving us toward a higher rate. And so we have a short squeeze that's going on right now. So that's the technical of today. But, the trend is higher, not only because of that positioning, but because the U.S. is outperforming relative to other countries.
Given that it's also August and a lot of people are just at the beach, which might be also part of the technical underpinnings of what's been going on, how focused are you on the 20-year auction today, which is coming at a time where there are these sort of new cycle highs for yields?
Yeah, the 20 trades very differently than a lot of the others because there's not as much liquidity in that. And so it'll be interesting to see what the uptake is, because what we saw, I believe a week ago, is that the 30, there wasn't as much demand, and that sort of set in motion this bid higher in yields. And so I think it'll be very interesting to see what happens with that particular auction.
How do you filter the core debate of whether this jargon are starred into the markets? Is there not a linkage or a one-to-one relationship, but then how do you synthesize Jackson Hole mumbo-jumbo into the real world of markets?
Well, Bill Dudley, I think he had a good piece out talking about R-star going higher. And, the way I'm thinking about it is in terms of the September SEP. So when we get the summary of economic projections, we've already seen the central tendency going up for the last dot. Maybe we see even more movement there. They've been at that level, 2.5%. If they go up beyond that with their mandate at 2%, that's telling you they're saying R-star is moving higher than 0.5%. Maybe they're going to be telling us they think R-star is now 0.7% instead of 0.5.
Played basketball recently?
No.
It's a threat to society. I always get hurt, and we got breaking news on this. Ed, thank you so much. Edward Harrison with us today on the markets. What you mentioned there's 8 people on stage tonight?
There may now just be 7.
7. This is Dana Bash over at CNN leading the coverage. Let me read it, Lisa. The North Dakota governor, Mr. Burgum, taken to a Milwaukee emergency room after suffering an injury while playing a game of pickup basketball with his staff. It is unclear whether he will attend tonight.
And so we will be reporting more about that. He was a long shot candidate. It wasn't as though he was one of the front runners, but still an important voice at a time where there are many, and we're looking for some new voices to come in that have been overshadowed by some of the other developments over the past couple of months.
Politics, I'll be honest, I haven't followed it. I leave it to Anne Marie Horton and Joe Matthew, balance of power. But Governor Burgum is a name from my youth. And you talk about this hysteria over NVIDIA right now. There was a somewhat equal hysteria over Great Plains software. And this is the guy, folks, who said, you don't have to be in Boston. You don't have to be in San Francisco. We can get this done from the Great Plains. And this was a huge, he made more money than God. I mean, he's got to be like Youngkin of Virginia, where, he can literally write the ticket himself. But maybe he can loan some money out to some of the others. But the bottom line is Doug Burgum is what everybody in this country is dreaming of. Steve Case, AOL, leading the way on this, doing innovation and technology outside of 4 zip codes in California.
I lived in Fargo, North Dakota. They've got a big Microsoft campus at the time, and that was part of the push. He did have to gin up some of his own pocketbook, though, to get people to donate enough so that he could actually be on the ticket, because he doesn't necessarily have that common name appeal. It's, that said, he does represent another time and place in this whole race.
Yeah, and so we'll see that. We'll have continuing coverage of that, of course, Anne Marie Horton and Joe Matthew tonight on Balance of Power with that. An incredible day. We're on our way to the airports here in about 60 minutes to get out to Jackson Hole. Lisa, what are you going to look for at Jackson Hole?
Just whether they do talk about the new neutral and whether they actually feel confident that a soft landing is not a pipe dream, that this is actually a base case in a real way, which a lot of people are raising eyebrows about.
For my mother, chip beef on toast, the Pioneer Grill.
You're going to eat it for your mother?
I'm going to have it 2 or 3 times. Only reason I'm going.
Miss Keene, this is for you.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, well, why? There's no rule book for it.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think in the first within 6 to 12 months, open up 3 or 4 large bases in Ukraine, and we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Big couple of days coming up. Live from New York City this morning. Good morning, good morning. Equities just about holding on here, trying to bounce on the S&P by 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, markets on edge ahead of key results from Nvidia. Retailers sounding the alarm on the consumer as the GOP prepares for a high-stakes debate without Donald Trump. We begin with the big issue, resilience or complacency.
The economy remains very resilient.
Data just continues to be very, very resilient.
Growth so resilient.
Equity markets remain quite resilient.
The U.S. consumer still remains extremely resilient.
It certainly looks as if third quarter is going to stay pretty resilient.
The economy appears to be on solid footing.
All this talk about a recession so far hasn't panned out.
I think we've gotten too optimistic on the growth front.
There is some complacency.
Market complacency.
People being very complacent. That usually leads to some sort of natural pullback.
It's really hard to see material upside to equities.
Over time, higher for longer should slow things down.
We still have this mild recession in the forecast.
We are going to have a recession at some point.
At some point, you're going to start to see things break.
At some point. Morgan Stanley's Jim Caron joining us now alongside JP Morgan's David Leibovitz. David, is it complacency or resilience?
So I think it started as resilience, but it does feel like it's beginning to morph into complacency. I think, you know, taking a step back and thinking about why the economy, the U.S. economy in particular, has been so strong this year, so much stronger than people expected, it really has to do with the state of the consumer and the state of the labor market. But, you know, we recognize the lag impact of shifts in Fed policy. We recognize that 12 months ago, you know, the Fed funds rate was still down in the 2s, and we think that, you know, a lot of these rate hikes that we saw into the end of last year are going to start to bite. And unfortunately, I think that this is coming at a time where markets are increasingly warming up to the idea that we could have a soft landing next year. I'll call it complacency.
Your colleague in the investment bank agrees. Marko Kolanovic saying this, compared to the start of the year, investor expectations, market positioning, equity valuations have moved up. Marko goes on to say, with soft no landing, the new base case, there is no more fear, only complacency. Jim Caron, which camp are you in?
I'd like to pick that apart a little bit and say that, look, the labor market has been very, very resilient. I think the growth sector, let's say like within equities, which is what's driving most of the indices higher, maybe that sector of the market has become a little bit complacent and dependent on those increases. So, you know, I think it's a good mix of the two. I think people are pretty worried. I mean, when you ask people what they think about the future in terms of recession expectations, they have them. They have the Fed cutting interest rates at some point in the first half of next year. They're only going to do that if we see a slow.
Bit of a technical problem there with Jim Caron over at Morgan Stanley. David Leibovitz, I'm pleased to say, is still with us. We'll reconnect with Jim in just a moment. David, just to build on some of the things we're thinking about here, I think Jim did a decent job at the start of those comments. Draw a distinction here between what's happening with the economy and what's happening with the market. You were talking about the market. Let's talk about the economy. Mortgage rates running close to 8%, 7.5%. Mortgage applications this morning, the lowest since 1995. Now, I would say, David, unsurprising. The question we've got to ask is just how rate sensitive is this economy? Are we finding out it's far less rate sensitive than we thought it was?
So we are finding out that this is a less interest rate sensitive economy than a lot of people originally thought. And, you know, primarily this stems from the behavior that we saw not only in the immediate aftermath of COVID, but really over the better part of the expansion post-2008, where consumers delevered, they termed out their debts, right? They took advantage of very low interest rates to extend the maturity of the loans that they were taking on. And overall, we have seen this create a less interest rate sensitive consumer, but we're also seeing it on the business side as well, where normally normally you would expect a big increase in rates to have an impact on interest expense. We're just not seeing it because, again, businesses have been successfully able to term out their debt, particularly over the course of the past couple of years. But you look at where mortgage rates are today. Importantly, you look at other parts of the world, namely Europe and China. Europe in particular, the manufacturing sector does look like it's coming under a bit of pressure here. And I do ask myself if this story of resilience in the U.S. economy is really dependent on the continued resilience and health of the consumer. You're seeing kind of the cyclical parts of the economy globally begin to crack, and I think it's just a matter of time before that shows up here in the United States.
Yeah, David, to build on that, China right now not great at all. The PMIs out of Europe just absolutely dreadful this morning. Germany, across the Eurozone, the UK as well. I'm pleased we've reconnected with Jim Caron because, Jim, I'd love for you to speak to this. The US economy, in the rest of the world, it looks like services is coming down to manufacturing. In the US, Jim, do you think manufacturing can come up to services?
Well, that's our core thesis. I do think it's more manufacturing coming up to services. Now, look, the base case that I have is that we're still going to have a soft landing. That still means we likely have a mild recession, but it's a mild recession. So I think the service sector, which has been strong, and I think certainly the manufacturing sector has gone into probably more of a recessionary type of a level. But as we see this resilience, I think in the labor market, I think that what you're going to see is more investment, more CapEx, and I think there's going to be probably more support for a softer landing. So I take the opposite view on this than probably most do. I think it's manufacturing going up to services.
25 minutes away from the opening bell. Equity futures right now on the S&P 500, just about positive by 0.1% into the bond market. We've gone through some big levels in this bond market in the last couple of days, the past week. The 2-year still really close to 5% at 499.25. We're down 5 basis points on a session today. The 10-year, after going through 430 and making a new cycle high in the last 24 hours, we're back down by 6 basis points to 426.67. Jackson Hole, the annual Fed get-together, kicks off tomorrow. Chairman Powell speaks on Friday, 10:05 Eastern Time. On the ground, Mike McKee joined us from Wyoming for a preview. Good morning, Mike.
Good morning, John. Well, you just mentioned the bond market. One of the big questions is, why are yields so high at this point? Bond market participants say there are a lot of different reasons, but how much of it is due to the Fed? That'll be one of the discussions here at Jackson Hole, along with what happens next. It's a question about structural changes in the U.S. economy. That's the title of this meeting. And do we see things change from the way they were before the pandemic permanently? Go back to maybe where we were in the 1990s in terms of yields. So a lot for them to discuss here. Jay Powell, as you mentioned, kicking it off on Friday morning with what is titled An Economic Outlook. Is he going to talk more about rates and where they're going? Maybe he will say the same thing he said before, that we're going to continue keeping rates high until inflation comes down. They have made a lot of progress since last year. Inflation way down from when we were here a year ago. Unemployment hasn't gone anywhere, still very low. Nobody really quite knows why. So a lot to discuss, and everybody's going to be looking forward to Jay Powell's speech and how much of a hint he gives Wall Street about what actually is going to come next.
Mike McKee, right now, just looking at you, I'm more impressed by this outfit than I am the backdrop. Mike McKee makes me want to go home and repack and get some new clothes for this trip. Mike, good to see you. Looking forward to catching up over the next couple of days. Mike McKee on the ground at Jackson Hole, Wyoming. Just absolutely stunning over there. Equity futures right now on the S&P, just about positive going into Friday. And Chairman Powell. David Leibovitz, what are you looking for from the Fed chairman on Friday?
So I don't think we should be looking for any big surprises. My sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying over the better part of the past couple of months, which is we've come a long way. We've made a lot of progress. We're not 100% sure that the inflation issue has been completely put back in the proverbial bottle, and so investors should expect interest rates to remain higher for longer. I think we're seeing markets reprice here and reprice more in line with what the Fed has been telling us, but there are still cuts in market pricing for 2024, and the only way that we get there, in my view, is if we see a more significant deterioration in the overall state of economic activity. And so I think what Powell's going to try to do is is lift those futures dots and try to bring them more in line with what the Fed themselves are forecasting, but really reiterating that message of higher for longer being the base case view down at the Fed.
Just to add to that, Jim, how far along do you think we are in that adjustment process to that higher for longer reality in the bond market specifically?
Well, look, I mean, I think the bond market's pricing it pretty well. I mean, higher for longer makes a lot of sense right now. There may be one more rate hike on the cards. Now, look, I think that Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit. What Powell and the Fed worried about was growth, and they were concerned about inflation. Today, I think they're going to really focus on inflation and have some concerns on growth. And the reason is that the labor market has proved to be very, very resilient, and now they believe that growth can be sustained, but now they absolutely have to get inflation down. So the veiled message I think that comes out of this is with Powell talking about higher for longer and talking tough on inflation. Essentially what he's going to likely do is steer us towards a mild recession. And for me, for one, the way that I would think about this, a mild recession that comes sooner is better than a recession that comes later, because a recession that comes sooner is likely mild. A recession that comes later is probably a harder landing. So I think Powell wants to get this over with quickly, get inflation back towards target levels, talk a little bit tougher, talk about higher for longer. And I think the veiled message is going to be probably towards a recession, although they're not going to explicitly say that, of course.
So, Jim, make it easy for me. Is that a buy for the 10-year or not?
So I think it's a modest buy. I think that these levels in yields can probably hold in reasonably well. I'm more concerned about the shape of the yield curve. Look, if the Fed cuts interest rates 100 basis points or 150 basis points, from current levels at some point in 2024, what's the shape of the curve? If the curve goes to zero, if let's say 2s, 10s goes to zero, that keeps the 10-year note right still around 4%, right? So, or 4 to 4.25. So I don't see a lot of downside in yield here unless we bake into the cake a hard landing.
David Leibovitz, final word. So to the opening bow. Here's Abby with more. Hey, Abby.
Hey, John. And there's certainly some big movers in the retail space and to both sides. As you know, Foot Locker absolutely plunging. This is the worst day, I believe, in at least a decade. I was trying to go through the calculations by hand, and actually, Netflix is up 1.7%. And as a Netflix subscriber, I'm very happy to have learned that they will be allowing us to keep the discs once they stop sending out the discs at the end of September, but also subscriber numbers on track. Now, Nike, one of those retail movers that I was talking about, Foot Locker absolutely plunging, as we were talking about, and that is, of course, on their slashed outlook, cutting the dividend, the stock plunging down more than 30%. Nike, 65% of their revenue going back to last year, their merchandise, so Nike falling in sympathy. And then Advanced Analog Devices, their outlook is disappointing. You can see that stock down about 4.8% more on retail in just a little bit, John.
Abby, thank you. We'll catch up with you around the opening bell. Coming up, retailers under pressure.
Biases in terms of consumers moving more toward generic type brands as opposed to higher end brands. If we start to see more cracks in the labor market, I think the consumer could maybe shut down the spigots fairly quickly.
Foot Locker getting absolutely hammered. That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
There's definitely some dichotomies going on, and I do think that part of it has to do with what consumers are prioritizing. They're continuing to prioritizing services, they're continuing prioritizing food and drinking places, and they're not so much prioritizing retail and furnishings. And I think that's part of what we're seeing in some of those retail earnings. That's really the undertone.
More pain coming to the retail sector. Foot Locker cutting its outlook and suspending its dividend, becoming the latest victim of a slowing consumer. The CEO saying we did see softening trends in July and are adjusting our outlook to best compete for price-sensitive consumers. It's the latest red flag from US retailers as Nike sees a record run of losses. Sales are dropping over at Macy's. Dick's Sporting Goods is warning about theft as Target and Walmart have their eye on student loan repayments. Walmart CEO saying this in the past week, resuming student loan repayments, higher borrowing costs, tightening lending standards mean household budgets are still under pressure. Katie Greifeld has the story. Hey, Katie.
Hey, John. Well, we heard it loud and clear from Macy's yesterday. We heard it again from Foot Locker this morning that resilient U.S. consumer may be starting to pull back here. Foot Locker shares off an incredible 32% pre-market on the heels of that forecast cut, and that's sending a chill through its supply chain as well. You take a look at Nike, you take a look at Under Armour, both under pressure this morning. They're both suppliers to Foot Locker. Nike, in particular, on track for a 10th straight day of losses, given that Nike, 65% of athletic merchandise was purchased from Nike by Foot Locker in 2022. Now, this Foot Locker report, it comes a day after that Dick's Sporting Goods report that you talked about just earlier. A similarly disappointing report and forecast there. It also cut its profit outlook for the year, and it also cited increased theft at its stores. We know that shrink is a problem for these retailers. But if you're looking for a bright spot, John, you will find it in Abercrombie & Fitch, actually boosting its profit outlook. Its Hollister brand returning to net sales. Urban Outfitters, too, also beat on earnings. John, my takeaway there is that teenagers are still buying clothes.
There we go. That's good to know. Katie, thanks for the update. Katie, thank you very much. It's mixed out there for retail. The negative headlines, though, they seem to be the dominant headlines, as always. Jim Karen, David Leibovitz back with us. David, there are reasons to worry. Are there reasons to worry a lot from your perspective, looking at some of those names that Katie just went through?
So I think the important thing to recognize is that, the consumer is 70% of U.S. GDP. So what happens with the consumer is very much going to dictate what happens with the economy at large. We are seeing signs that consumers are coming under pressure. You can look at the savings rate, which is well below its long-run average, the increase in credit card use. If you look at kind of excess savings, right, according to the Federal Reserve, they believe that it was exhausted in the U.S. Over the course of the summer. And so I think you're beginning to see the consumer bend more so than break. But obviously, that does suggest tougher times ahead for the overall U.S. economy.
Here's the constructive way of looking at it. Mark Zandi, Moody's, he says this: income growth is now stronger than inflation. The need for excess savings to support continued sturdy consumer spending is thus fading. Jim, would you take that favorable view of things going forward from here?
No, I'm a little bit more skeptical and a bit more cautious on this. Look, the way that I see this is I see the consumer is starting to weaken. But look, The reality is that interest rates are rising. This is what's supposed to happen. This is how you cool down inflation. So this is all part of the overall plan. Where I start to get a little bit more concerned then is what do these companies do in terms of trying to address profit margins? So what they were able to do before, because people had a lot of money coming in and savings, is every time inflation went up, they just raised prices and they kept their margins the exact same. Today, now they're not going to be able to do that, so they're going to have to cut prices in order to get the same amount of volume moving through their stores. So the reality is that you end up getting a narrowing of profit margins, which could also hurt earnings growth. And then that probably leads to some of the wobbliness that's in equity markets today. Now, I don't think this is the end of the bull market or anything like that for equities at all, but I do think that we could see an additional adjustment lower as the markets start to really internalize what it means to have a soft landing in a mild recession. If we have that, which I think will come up at some point in the future, maybe in 2024, possibly, the reality is that there has to be some price adjustment in these assets. And I think that's happening, but I think it's a correction. I think it's an adjustment. And again, the sooner we get this over with, the better off we're going to be.
Well, let's pick out a part of the market, specific part of the market. David, let's talk about consumer discretionary. Huge outperformance this year in places like airlines, elsewhere for the cruise operators as well. We've seen big gains through 2023. And David, you know the story. We brought forward all that goods demand in the pandemic. We pushed out all that services demand, and we're working our way through it now. Working our way through that excess savings, working our way through all of that pent-up services demand, to go on vacation, to fly, to go on cruises, whatever. David, are we at that point now where you think we should fade that story in the equity market?
So I do think that it is becoming the time where we want to fade that story. And I recognize the point that you made about, real income growth being positive as inflation has started to come down. But I tend to think that the impact of that overall dynamic on profit margins is really the one to watch. And I think we talked about this a couple of weeks ago. If you're a business that's trying to defend their margin, you basically can do three things. You can pass along higher costs in the form of higher prices. You can reduce your investment spending, or you can reduce your employment. And, to the point that was made earlier, right, that ability to increase prices, it's fading. Inflation is coming back down to earth, and that pricing power is finally running its course. That means that businesses are going to have to make a tough decision. Do they pull back on investment spending if there is some to cut, or do they have to pull back on employment? I think we're increasingly getting to the point where you're going to see businesses pull back on employment, and that obviously undermines a lot of the strength that we've seen in the consumer over the past 12 to 18 months.
So, David, you've explained what you don't like then. Tell me what you do like in the equity market right now. What are you advocating for?
So we'd be focused on hitting singles and doubles. To me, this is not a market for heroes. We like the lower beta dividend-paying stocks, consumer staples, utilities, so on and so forth. We would be inclined to add to growth names if we saw valuations re-rate, but given where a lot of those companies are trading today, we just don't love the entry point from a valuation perspective. So kind of straddling the line between value and growth, leaning a bit more into value today, but definitely dipping our toes in growth when valuation presents us with that opportunity.
Jim, I've got a minute on the clock. Final word, please.
So look, I agree with a lot of what David's saying, and what I'll say is materials and industrials are areas that we're also looking at as well. We do think that the U.S. is in a manufacturing renaissance. It's trading a little less with China now, trading more, with Mexico and other places, Canada as well. So I do think that the materials and industrial sector, once we get a broadening of the breadth of the rally to start to come through, I think those are going to be good, very good places to be. Growth, we still like it, but it's name specific and it's going to be valuation specific. Fixed income, look, we still like higher yielding assets in the markets. We don't think we're going to go through a large default cycle, although there will be some stress near term, but we see this largely as a buying opportunity.
Neat and tidy within 60 seconds. Jim, thank you. Jim Karen alongside David Leibovitz. To the both of you, thank you. Equity futures right now, just about positive on the S&P 500. Coming up, the morning calls and later. UBS's Nadia Lovell, steering clear of big tech stocks ahead of earnings from NVIDIA. That conversation still ahead.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Equity's doing okay here, about 5 minutes out from the opening bell. Just a little lift going into a big earnings report later on this afternoon. That's the price action. Here are some morning calls for you. First up, Edward Jones upgrading Dollar General to buy, expecting growth to re-accelerate due to improving fundamentals and weakening competition. Your second call from Morgan Stanley upgrading Brown-Forman to overweight from underweight, raising shares by 2 notches as margin headwinds turn into tailwinds. And finally, Wedbush downgrading Dick's Sporting Goods to neutral, seeing a challenging outlook as consumers cut spending on leisurely sporting items. I think that's something about barn doors and horses bolting, and I think you know what I mean by that. The stock is down by 2.8% after cratering in yesterday's session. Coming up, the best performing stock of the year reporting after the closing bell. Nadia Lovell of UBS on why she's steering clear of big tech.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Bloomberg covers powers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We've hit a rough patch in this equity market, down for 5 days out of 6 on the S&P, trying to bounce. Elevated this morning by just 1/4% on the S&P 500. On the Nasdaq, up by 1/3 of 1%. Two big events. One on Friday, Chairman Powell. The second one a little bit later, Nvidia after the close. There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year. A rally for once. How refreshing in the Treasury market. Yields are lower by 8 basis points to 4.2469. The euro weaker. I've said this a million times. I know I'm on repeat. The data out of Europe, dreadful. 108.28, the euro negative by 0.2%. Crude lower as well. A break is 78 on WTI. 77.96, we're negative there by about 2%. 20 seconds into the session, here's the state of play for you on the S&P 500, up by 0.25% on the S&P. The Nasdaq with a similar move. Nothing like that on Foot Locker. That's the stock to watch at the open. Shares getting absolutely hammered after the retailer cut its outlook and suspended its dividend on weakening spending patterns. The CEO saying this: we did see a softening in trends in July and are adjusting our outlook to allow us to best compete for price-sensitive consumers. Abby has more. Hey, Abby.
Hey, John, and on this, we are having a record softening pattern on the stock. It is having its worst day on record, going all the way back to July of 1980. And what makes this amazing, this stock into this report already down 39% on the year. There's a 21% short interest. So this weakness not taking everybody by surprise, but even with that expectation, we still have the stock down so much. They've absolutely slashed the earnings guidance by as much as 35% for the year. As you know, they suspended the dividend. There is that 11% short interest. So these trends that they're talking about, that they're seeing, they're really moving into the numbers, the financials, investors slashing the stock as a result. But it's not just Foot Locker, and this is a real story of the haves and have-nots, because we have Abercrombie and Fitch. They boosted their full-year view. The namesake brand was strong. The teen brand Hollister also strong. Kohl's going in the opposite direction, not just from Foot Locker, but Macy's also. They put up 125% earnings beat. Their inventories are improving. They're clearing out the merchandise, optimized assortment, all positive. And then Urban Outfitters, another strong one, a 24% earnings beat, 1.8% sales beat. The discounts are fading, and apparently their customers are choosing fashion over price. So on the year, it stands out that Abercrombie and Fitch, or excuse me, Foot Locker is the stock that's down into today, down 39%, whereas Abercrombie and Fitch up 80%, Urban up 43%. Again, a story of the haves versus the have-nots.
Abby, thank you very much. Foot Locker does not have a lot right now. It's negative 34% in early trading. Nike, 10-day losing streak over that period, down more than 11%. That is a record losing streak for Nike right now. That stock is negative on the session by 4%. Let's stick with earnings. Toll Brothers topping Q3 profit estimates on increasing home deliveries and surging unit prices. The CEO saying this: while rising rates remain a challenge, they further cement the lock-in effect that's kept resale inventory at historically low levels. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Toll Brothers up more than 2% after delivering that beat and raise third quarter EPS revenue and total home sales all beat estimates. And the look ahead is similarly rosy. If you take a look, the luxury home builder sees year-ahead deliveries between 9,500 and 9,600. The lower end of that range was previously the upper end of their forecast, so raising that. And Toll Brothers also boosted its gross margin forecast. That is boosting the stock this morning. As the CEO said, this extremely tight housing market, it's been good news for the home builders in general, and particularly for Toll Brothers. Resale inventories are historically low due to very high rates, but also due to the fact that we're coming out of a decade of underproduction of homes. That dynamic, of course, has been a tailwind for shares all years. You take a look at Toll Brothers up more than 50% in 2023, John.
Nobody's selling their house. Nobody's going to anytime soon. Katie, thank you. Toll Brothers up by close to 2%, as Katie mentioned. Let's stick with that name. Just a word from the South Side. Raymond James, seeing plenty to like from the earnings report, writing this today. With its rapidly improving operating efficiency and best-in-class land positions, we believe Toll Brothers warrants a tactical move to the analyst favourites list to take advantage of the recent pullback among builders due to rising interest rate fears. That stock is up by close to 1%, just fading just a touch. Peloton. The tough year gets even tougher. The company issuing a disappointing forecast due to weakening subscriber trends. The CEO saying, quote, the slowdown exceeded our expectations as consumer spending shifted towards travel and experiences. Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, analysts hoping for commentary about the company's transformation, sweetened, as a Bernstein analyst put it before the results, by a nice surge of new app users. Instead, they got that negative commentary on subscribers, in addition to more trouble on its hardware business. A recall of about 2.2 million seat posts, costing more than $40 million than it had anticipated. And in addition to that, 15,000 to 20,000 subscribers choosing to pause their subscriptions until they got those new seat posts. They've received about 750,000 requests for that seat post replacement. The dented that first quarter forecast, that's the next quarter, they think they're going to see a loss of $10 to $20 million. Analysts were anticipating a profit. Perhaps the only positive things there was that their fiscal fourth quarter was roughly in line with expectations, and subscribers were up on a 3.8% year on year. But in a shareholder letter, the CEO writing to stockholders, I'm signaling significant potential upside, but considerable uncertainty, John.
Simone, thank you. That stock is down by 21%. The two big events of this week, you know them well. Chairman Powell on Friday in Jackson Hole, Wyoming. After the ballot a little bit later, earnings from NVIDIA. The equity market darling of 2023, the vehicle to chase AI hopes and frenzied dreams, following a more than 200% gain for the year so far and a blowout quarterly report last time around. Just how high is the bar going into today's results? Ed Ludlow has more. Hey, Ed.
Good morning, Jonathan. Sky high. I mean, NVIDIA earnings on the same plane as Fed Chair Powell at Jackson Hole. I like that. In all seriousness, the story is, does the AI momentum that NVIDIA has seen in 2023 have staying power? The expectation is 65% top-line growth for $11 billion of revenue in the fiscal second quarter of fiscal year 2024. It was interesting, Citigroup had a note out that for institutional investors and clients, their expectations are even higher, $12 billion of revenue. Either way, the average analyst estimate and that 12 billion institutional figure is above what NVIDIA guided last quarter. The staying power story, we go to the full year fiscal 24 guidance for revenue. The estimate for that is $43.98 billion. There are those out there in the market who want to see some revision higher on that in terms of the guidance that NVIDIA gives. In the quarter that they report, the fiscal second quarter margins on an adjusted basis, 70.1%. We might get some evidence that margins continue to creep higher throughout the year. If there's a concern, it's on the supply side. Was NVIDIA able to get the chips that it needed from its contract manufacturer, TSMC? Of that $11 billion of sales, around $8 billion is for data center, and that really feeds into the AI story, those higher margin chips. We're talking H100. We also want signs of demand for the next gen chips, the GH200, for example, that NVIDIA announced earlier this month. The market is waiting for this one, John. I think the options market's pricing in an almost 10% swing. This is a stock that is almost 4% of the S&P 500 on a weighting basis. I'm incredibly excited. Look forward to it.
It's the story of the year in the equity market for sure. Ed, thank you. The stock of the year. No dispute about that on the S&P 500, given its performance so far. And for some of you, I know, it's the story of the week. Much more so, perhaps, than Chairman Powell on Friday. We'll see about that. Nadia Lovell at UBS expected a shift in leadership within the equity market, seeing upside in beaten down energy stocks and keeping big tech on her list of least preferred sectors, along with real estate, and utilities. Nadia Lovell joins us now for more. Hey, Nadia, let's start with tech. Why steer clear of some of those big names?
You know, as we know, it's been a well-loved sector, and valuation is quite elevated. I mean, our view is a lot more nuanced. I mean, we've seen tech take a little bit of a breather since July, down about 7% since mid-July. You know, the earnings reports were quite mixed. Of course, we continue to see weakness in PCs and smartphones, and that did have impact on some of the semiconductors and hardware companies. The IT budget environment is still quite tepid. You know, but that said, I mean, the AI theme we think is strong and here to stay, and so that's why I say there's nuances in our view. When we sort of look out on the horizon, we do think that demand, AI demand is broadening. We heard that throughout the earnings season. CapEx related to AI is increasing, and our expectations for the end market demand for AI over the next 5 years, we think is going to be a 60% CAGR. But that said, Jonathan, you want to remain selective at this stage and really be valuation sensitive and really focus on those companies that have, you know, distinct monetization opportunities and developments.
Well, Nadia, elsewhere, as you know, massive multiple expansion through the year so far. A huge adjustment in the yield curve too, more recently, much more so over the last month. Do you think there's some tension there that needs to be resolved between what we've seen develop in bonds more recently, in rates, and what we've seen in multiples all year?
Absolutely. That's been one of our points, that we think that valuations are quite elevated. Yes, they have come in a bit in the last few weeks, but they're still elevated in the context of higher rates. I mean, that said, in terms of the pickup that you've seen in bond yields, this is partly why we have a slight preference of bonds over equities, just given valuations. But we do expect bond yields to come back in. We know that some of this has been driven by technical as well as fundamental factors. The huge expectations of supply coming to the bond market to fund our looming government deficit. But when we look into the end of the year, we think that the economy will slow down, inflation will abate, and as we look forward into 2024 and the possibility of rate cuts, we do think that yields will come back in. And so we're looking for the 10-year to be in the range of 3.5 to 3.75 by the time we get to the end of the year.
Nadia, as you know, at the moment, growth is above trend. You believe in sub-trend growth by year end. Nadia, can you identify maybe some subtle signs that slowdown in this economy is starting to build?
Mm-hmm. Absolutely. I mean, look at some of the retail earnings, right? We know that the Atlanta GDP now is trending at 5.8% for this quarter. We think that that's going to come down, but we are expecting near term, John, at least for the third quarter, above trend economic growth. But when we look into the end of the year and into next year, we're looking for more GDP sort of be sub-trend, probably in the 1% range. I mean, there are cracks of the consumer. Yes, the consumer remains strong overall, but there are pockets of weakness, whether you look at delinquency rates going up, whether it's in autos or on the credit cards for some of these retail companies, we're seeing that. And so we do expect consumer spending to start to slow as consumers' excess savings dwindle.
So Nadia, one thing that stands out, and you and I have talked about this before, and you can help me explain it, you maintain a Brent target of 90 year end, even though you expect growth to go from above trend to sub-trend, and you also like energy stocks. Just reconcile those things for us.
Well, Jonathan, we have actually updated our Brent target to $95 by year end, and we expect that to continue into 2024. I mean, when we think about energy, of course, the demand side still looks very strong. Record level demands probably this month. And even when you're seeing weaker economic data, activity data, and industrial data from China, reality is the mobility data is still quite strong. And so oil demand has remained strong for China. When we look at some of the data around waterborne crude oil, it's actually imports are actually looking to be record levels. And then, of course, on the supply side, we have OPEC Plus that has been production cuts are near has pushed production down to a near two-year low. And we know that those production cuts for Saudi Arabia and Russia extends into September. And so we think that all of this is going to support high oil prices. We're looking for a deficit of 1.5 to 2 million barrels a day through September. And so we continue to favor the energy sector as a result of this. Also, oil, long-dated contracts, markets right now is in backwardation. And we've also been advising clients to really use volatility strategies and sell downside to oil as well.
Are clients giving that trade any love, Nadia? Given that you're telling them slow down in China, slow down in Europe, slow down in the US, buy crude?
Yeah, well, you know, the recent prices that we've seen through this summer helps to encourage clients to leg into that trade.
Nadia Lovell, the update over at UBS. Nadia, always enjoy the exchange. Thank you for joining us as always. About 13 minutes into the session. This is what we look like at the moment. Going into NVIDIA later on this afternoon, we're positive by 1/3% on the S&P. On the NASDAQ, we're up by 0.4%. Coming up, the GOP squaring off in Milwaukee.
This is going to have to be their breakout moment. Americans are looking for people who are going to solve problems, who will address some of the issues that we're facing. And they're not looking for somebody that just can be the nastiest on stage.
8 GOP hopefuls looking to stand out on stage. Team coverage up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Downside surprise, the dividing line between expansion and contraction on a PMI, 50. Sub 50 on manufacturing, 47. The estimate, 49. On services, 51. The estimate, 52.2. This is a preliminary reading for the month of August. 50.4 on the composite. The estimate, 51.5. Off the back of that data, big bid comes into the bond market, a rally. Yields lower by almost 11 basis points at the front end. We've seen some big moves in the other direction more recently. The 2-year now, 494. The 10-year down 11 basis points to about 421 after hitting a cycle high well through 430 earlier on this week. Off the back of that, yields lower, dollar weaker. The euro, bear in mind earlier this morning, the data out of Europe was, to use a word I've used all morning, Dreadful. The euro was much weaker. The euro at the low of the session, 108.03. We now fill the gap, almost unchanged on the session at 108.43. So the dollar weakness kicks in on the other side now off the back of weaker than expected economic data out of the United States. Weaker data, will that be a focus for the debates a little bit later? It's round one of what's set to be a brutal fight going into 2024. GOP presidential hopefuls squaring off in Milwaukee, Wisconsin. And who won't be there is perhaps just as, if not more important, than who will be.
Donald Trump.
President Trump asked me to put him over the Constitution, but I chose the Constitution.
They care deeply about Obamacare. And Donald Trump promised him he'd repeal and replace it. He had a Republican in Congress. He didn't do it.
It really does take 2 terms as president to be able to finish this job.
He would need 110 years as president to be able to finish the wall. He didn't get it done.
His policies during the 4 years he was in office were very positive for North Dakota.
It would be a lot easier for me as a Republican candidate in this race if Donald Trump were not in it.
The former president with a commanding lead in the polls, the latest from CBS YouGov, leaving his closest challengers well behind and looking to close a widening gap. Your team coverage starts right now with Bloomberg's Anne-Marie and Kelly Lyons down in Washington, D.C. AMH, what are you looking for a little bit later?
Well, Jonathan, there's a few developments over the past hour that is really going to highlight this evening's debate. One, we do know that the former president, there's been lots of reporting about him sitting down with Tucker Carlson. Well, actually, the former president took to Truth Social and said sparks will fly tonight. They're going to air that interview on Twitter at 9 p.m., so exactly when the debate starts. So this is Trump really just owning into his base and shrugging off the RNC. When it comes to the actual debate stage, another development is that Doug Burgum, the North Dakota governor, who you saw there speaking on balance of power as well, will potentially not be in attendance. He was playing a pickup game of basketball this morning, hurt himself, went to the emergency room in Milwaukee, and it remains to be seen whether or not he's actually going to make that stage. Then we're definitely down to 7. And one thing to focus on, center stage physically will be Ron DeSantis, given the fact that of these individuals that are on the debate stage, he is leading in the polls, but also he's going to be center of those attacks. He needs to try to hold himself in that second place. And then, Jonathan, potentially there's an opening for someone else.
Kelly, that's the people. Let's talk about the issues, the substance, China, Ukraine, the economy, the former president. Kelly, what tops the agenda later this evening?
Well, they're not going to be able to avoid talking about the former president. He is the elephant that is going to be very much not in the room this evening. And even the Fox host of this debate, the moderators, have indicated that they will be playing sound of the former president in their questioning. So he is going to be unavoidable. But polling has showed just as recently as within the last week that what voters really want to hear about is substantive policy. The economy obviously will feature probably incredibly highly, as many of these candidates have said that Biden administration policies have contributed to inflation. Voters likely will want to hear what their plans to fight inflation realistically will be. And then on some of those foreign policy issues, everyone seems to be trying to out-hawk each other on China. Doug Burgum, who may or may not be in attendance just last week when he was speaking with us here at Bloomberg, was talking about the Cold War we're in with China and how it must be won. So that messaging will be key, potentially talk of sanctions as well from some of these candidates. And then the issue of Ukraine. There is a bit of a divide within the Republican Party about what U.S. support should look like going forward. Of course, Ron DeSantis, who is likely, as Anne-Marie said, to be the target of many attacks tonight, previously called it a territorial dispute, then had to walk that back. Mr. Ramaswamy, who is looking like he is potentially in third place, could gain some momentum here, also has indicated that the U.S. should pull back support for Ukraine. So those are going to be some things to focus on. And, of course, we've heard from a number of these candidates about the fate of Fed Chair Jerome Powell as well. Mike Pence suggesting he wouldn't reappoint them. Chris Christie, though, told Bloomberg he maybe would, so market watchers likely will be watching that closely, especially ahead of Jackson Hole, John.
MH, as you know, winning a primary is very different to winning at the national level. Where does Ukraine feature in that effort?
Well, Ukraine is at an interesting point right now when you look at the Republican Party. As Kayleigh noted, you have some serious divisions, but also it's a difficult line for some of these candidates to walk. One, when we saw Ron DeSantis make that kind of fateful issue, saying that Ukraine is just a territorial dispute. He then had to walk it back, but also that really spooked some donors. The other issue why Ukraine is so important right now is because Biden is asking for more aid, and this is becoming a huge issue on the budget fight on Capitol Hill. And potentially, Jonathan, we might see a showdown when it comes to a government shutdown by the end of September, and Ukraine is playing very large when it comes to that. The far right of the Republican Party in Congress do not want to give more aid to Ukraine. So what the candidates say this evening could potentially give those members in Congress more of a nudge to continue fighting to not send more aid.
Anne-Marie, thank you. AMH, alongside Kelly Lyons, to the both of you. That debate later on this evening. Right now, I hate saying this, but this is how it's playing out. Bad news is good news for this market. Equities up, bonds bid, yields lower. Coming up, your trading diary.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
This is Bloomberg.
The headline today, disappointing economic data on both sides of the Atlantic, a rally in the bond market, a rally in equities as well. That's the price action. Here's the trading diary. New home sales coming at the top of the hour. NVIDIA earnings after the closing bell. And the first GOP presidential debate kicking off later on this evening, 9 p.m. Eastern Time. Another round of jobless claims and durable goods coming on Thursday. And finally, I'll see you over in Jackson Hole. Kicking off tomorrow with Fed Chair Jay Powell speaking Friday at 10:05 Eastern Time. From New York, this was the countdown to the open. This is Bloomberg.
CFOs are reshaping the C-suite, Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, coming up, we get some economic data crossing the tape. We'll break that down for you. We're also going to talk to Erica Edelberg, mortgage-backed security strategist with Bloomberg Intelligence. What are we seeing in the mortgage market? New home sales, all that coming up. Omar Aguilar, he's the CEO and CIO at Schwab Asset Management. We're going to get his market call. Then Catherine Daugherty, finance reporter with Bloomberg News, has got a great story out today on Merrill Lynch, Bank of America, fighting for market share against the big guys at Goldman Sachs and Morgan Stanley. Having some success, too. We'll get to that. But first, let's go to John Tucker and get a Bloomberg Business Flash.
All right, let's get right to the data. Did used home sales yesterday. New home sales in the U.S. coming in a lot better than expected. 714,000. That's an annual rate. Month over month, a rise of 4.4%. Keep in mind, last month it was down 2.5%. Maybe even more importantly, the U.S. payrolls, they're going to be revised down by 306,000. This comes from a preliminary estimate. And as we await a speech from Fed Chair Jerome Powell on Friday, Liz Ann Saunders at Charles Schwab is telling us the market seems to be ignoring any message of higher rates for longer.
I think that's the disconnect right now is next year's expectations for easier policy relative to, I think, the more likely stance by the Fed, which is to kind of, hang out at the terminal rate for a while.
S&P 500 right now up 22 points. The Dow up 78. The NASDAQ 100 up 126. NVIDIA shares right now, they're up 0.7%. Two-year yield down 10 basis points. The 10-year yield 11 basis points lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We've got some breaking news right now. Let's go to Nathan Hager down in Washington, D.C. for some details.
Nathan Dean,
It's Nathan Dean.
Oh,
Bloomberg Intelligence. Look.
Yep.
See there in the
I see him. Look
lower
at him.
right-hand corner?
I see him. Nathan Dean,
we are
Bloomberg
streaming
Intelligence.
live on YouTube.com, by the way. So if you type in Bloomberg Radio in the search on YouTube.com, you can see us. You see me, my bright green shirt there, and you'll see Nathan Dean in a moment. Nathan, we got headlines across the terminal that the SEC is going to finally impose these new hedge fund and private equity rules, fee disclosure, treatment of certain investors, and the hedge fund industry has threatened to sue over this proposal. What do we know?
So essentially, this is a proposal that would require the hedge funds and private equity funds, private funds, to disclose a lot of information, including compensation, fees, performance, and so forth like that, expenses. And this is a standardization or a standardized disclosure so that an investor can essentially compare and contrast the performance of one fund versus another. In addition to this, it would also prohibit certain conflicts of interests. One of the more interesting aspects of the proposal is if you're going to cash out an investor and you're going to give a certain rebate or allow that investor to cash out at a certain percentage, you have to make that available to all different types of investors. Now, like you said before, the Managed Fund Association and the trade associations hate this rule. It's going to be significant costs in terms of compliance headaches. The big funds should be okay, but this is really also going to increase competition amongst the smaller funds. We certainly anticipate the funds will sue. They've said that they could sue within the first 2 weeks. In fact, the Managed Funds Association's comment letter, before it was finalized, said that they were attacking the cost-benefit analysis of the rule. For those of us in Washington, that's essentially a key word: we're going to sue you. Now, the SEC did make some changes. They actually took out some language that made it a little bit easier for people to sue funds, but I certainly don't think that's going to keep the MFA and the other types of fund industries from taking this to the courts.
So, again, just give us the history here, Nathan. Is this a solution in search of a problem, or is there really concern out there about disclosure from the hedge funds?
So I think what this is that they took a consumer level initiative, which is disclosures to consumers, and thinking, just the not sophisticated investors, but just disclosures to individual consumers, and then they applied that to the private fund industry. Now, the SEC will say, look, there's $18 trillion in assets under management in these funds. Investors need to know what's happening here, but the funds come back and say, look, we're dealing with sophisticated investors. We already give them these types of disclosures anyway. So I'm not exactly sure that this was really, I think, the most important rule that the SEC should have been working on, but obviously it's one of the biggest and more dramatic impacts to the fund industry. This is something the SEC has wanted to do for a while now, and we will see when we get the final language when these funds have to start complying with it. I should also note that if you are a non-U.S. fund, as long as you take in U.S. money or U.S. clients, you're going to have to adhere to this as well.
I mean, if they already give them these disclosures, I can't imagine why compliance costs would climb, right? If you already are transparent about your fees and expenses, then you should just be able to publish that. It seems like they might be fighting back more, Nathan, against rules that would prohibit them from allowing favored investors to cash out more easily than others.
Yeah, absolutely. I mean, for the big funds, the compliance cost looks they already do this. But for a lot of smaller funds out there that don't have this type of legal or compliance expertise, they're certainly going to have to ramp up there. But like you said before, I mean, the biggest issue here is the comparison angle. If there is some type of secret deal that's going on out there, well, that deal now needs to be made public. And if you're going to compare against one fund versus the other, and some of these comparisons also have to go down to the portfolio level, so not just the entity level. If you're looking to invest in a hedge fund or a private equity fund anytime soon, you're going to get a lot more information on how to make those decisions, and competition is going to increase as a result. We've seen some economic evidence. I'm not sure if I actually buy into this, but we've seen some economic evidence cited by the SEC that fees will go down as a result of this. That will have to be played out over the next few years.
Yeah, exactly. All right, yeah. Nathan, hey, thanks so much for joining us. Nathan Dean, he's a senior U.S. policy analyst with Bloomberg Intelligence. Absolutely spot on this news here coming out of the SEC with some more fee disclosures. Looking at the market right here, Matt, we got nice and green on the screen. S&P 500 up 0.6%. Let's check in with, our good friend, Nora Melinda. She covers the markets for Bloomberg News. Nora, what are you looking at this morning?
Looking at a few things here this morning with stocks in the green, we are looking at Toll Brothers, of course, after this new home sales data came out this morning. The company reported earnings post-market last night and beat on a lot of metrics, but in this morning, in their earnings call, they said that August was an unusually strong month and that U.S. housing, affordability is obviously still an issue. I'm thinking about that as a broader issue, but the company did say that 25% of buyers in the third quarter actually paid in cash. So that's a pretty,
really?
Right.
How many?
25%.
Unbelievable.
That's like Matt walking up to his crib in Westchester, just laying the money down.
Right, and these are luxury homes we're talking about.
Yes.
25%. I thought that was insane. But
well, because they're luxury homes, right?
That's a valid point.
This clientele can afford to pay in cash.
Right. And speculative home sales actually accounted for about 40% of orders in the third quarter. So
it looks like the home builders are stepping up here.
They are. They keep
Cranking them
stepping
out.
and stepping. And of course, most of them don't really report until the end of next month. But this is kind of shedding some light onto what we could expect throughout this upcoming earnings season. But over into the retail space, I'm looking at Foot Locker. Foot Locker is down this morning. It reported some disappointing results following Dick's results yesterday. We had suppliers like Nike falling yesterday after Dick's reported, and Nike has extended its route this morning.
You know what I don't understand? You saw the Dick's numbers yesterday. So while I'm selling my Dick's Sporting Good, I'm selling my Foot Locker.
Right.
Why is the stock down 33%?
Well, the thing is, one of the big problems at Dick's was theft, right? Shrinkage was an issue for Dick's. And you don't see that kind of problem at Foot Locker.
No, I think you do.
I don't think you do, because you only have like a size 9 on display that someone can grab, right? And only the left shoe. So, how much theft could they really have?
One shoe, hobble around.
But did Foot Locker call out theft as an issue?
So I know that was like more in the Dick's vein, but I'd have to look a little bit deeper in that space.
If I'm selling my Dick's Sporting Goods, I'm selling my Foot Locker like side by side. So, but a big move there, 34% decline
And as you're looking
today.
at Foot Locker, it really just shows more evidence that U.S. consumers could be pulling back a little bit on spending as the company is cutting its annual sales forecast.
Foot Locker did mention inventory shrinkage, an industry term that refers to factors such as shoplifting and employee theft, has increased over time, but it wasn't one of the top impacts on margins.
Interesting.
Good to know.
Yeah.
Well, there you go.
Abercrombie and Fitch?
Yes.
Cool again?
Apparently
is
so.
Is it back? Is it really?
It is surging. That stock is up. Really healthy business there. And it soared on better than expected quarterly results.
Stock's up 20% today. 52-week high.
It's
you
just,
got to get back in the Abercrombie
soaring.
and Fitch.
It's like
bud.
everything from the 90s is coming back, and I want to just warn the kids of today. It was a great decade, but it's not always a good idea to emulate that kind of fashion. It's super embarrassing to look back and realize that your friends paid money for jeans that were ripped before you even bought them. You know, acid washed is not a good look. Mom jeans, you're not gonna like that decision later in life.
And with the ripped jeans, you're getting less material for more price, upwards in price, paying for less. But obviously Nvidia's in focus as they report after the bell today. That stock's up about 1.5% right now. But of course, everyone's kind of interested to see what they report. What will it be? Will it be positive or negative? And how will this impact the AI rally of this year?
Yep. All right. Very good. That's going to be, that NVIDIA numbers, it's big for NVIDIA shareholders. I think it's big for the tech space in general. But, if you listen to the strategists like Gina Martin-Adams, she says it's been obviously a big driver of the performance we've seen so far this year in the market overall. So that will be a highly anticipated print and then conference call. So good stuff there. Norma, Linda, thank you so much. We appreciate it. Again, a cool chart that came out this morning from Dan Curtis from Bloomberg. I'm not sure who created it internally, but it just kind of goes to looking at the mortgage market, and the outstanding mortgages are still at a very, very low rate. So it compares this chart, which is great on radio. The new, obviously the 30-year fixed rate is about 7.3%, but the effective U.S. interest rate on mortgages is down about 3.6%. So a lot of people are still holding really, really cheap mortgages, and that's kind of what you see out there. So let's talk
what
about
you'd expect. Who in his right mind would buy an adjustable rate mortgage?
Right
Paul
here,
Sweeney
baby.
did it.
I got a 6 handle. I felt like a knucklehead, but now not so much.
I get that you pull the trigger on that when you're looking at the highest rates, and now we're at the highest mortgage rates since the year 2000.
I know, but estates on the Jersey Shore don't come up every day. So when one popped up, you had to jump at it. Man.
I get
so
that.
You know how that works. Erica Edelberg, mortgage-backed security strategist for Bloomberg Intelligence, joins us. Erica, we had some new home sales data come out today. What's your sense of what we saw? Builders are building, it looks like.
Yeah, it actually surprised me. We saw, I mean, to be fair, this is actually reflecting mortgage prices probably that were maybe prior to the latest jump up.
Yep.
But we're still seeing the share of new homes increasing. They're about 16% of total sales now. And what the things that surprised me today.
So 16%, sorry to interrupt, 16% of total sales, is that higher than average, lower than average? Where are we?
Yeah, it was down to like 6% like a couple of years ago. So
right, and so the long-term average, new homes built, maybe 10% of the stuff being bought and sold?
Yeah, generally.
Okay, so now it's higher.
Yeah.
Because Matt's not going to sell his Westchester retreat because he'd have to go.
Because I locked in at 3.25%.
Darn right. So that's the problem, right? Or that's the issue.
Well, the other things that surprised me were the fact that the home prices actually, and it's a bit more of a jumpy series than existing home prices, but existing home prices and new home prices in the last month's report were more or less, median prices call it, were more or less equal. Usually new homes traded about 25 to 30% higher than existing homes. And then this month it completely reversed. So the median price for the new homes is now like 436, and for the existing homes is now back to 406. The existing home price fell a little bit, as you'd expect seasonally, but new home prices actually jumped a bunch from 415 last month to 436 this month. So that's interesting. So it's not just that they're cutting prices.
Erica, what is the 30-year mortgage rate you look at? Because obviously it varies depending on a borrower's credit quality and, the asset, et cetera. But I see, in official Bloomberg stories, a much lower rate cited than I see on the bank rate 30-year mortgage, right? So we're saying 7.3% right now and sounding the alarm. Meanwhile, the bank rate is over 7.6.
Yeah.
What's the rate that you look at and why?
I do like to look at bank rate because it's available daily, Mortgage News Daily also. But the big difference when you're looking at mortgage rates is looking at what they call effective rate, so what you're paying if you hadn't paid points versus what the contract rate is, which is where a lot of people actually take out the mortgage because they are paying points. So once you adjust for the points and look at a no point adjusted rate, it's always closer to the bank rate number. So even on the MBA 30-year fixed income index that they released today, we have an index in Bloomberg that they also released called MB30ER, effective rate. And similarly, we back out a no point Freddie Mac rate, and those are all above 7.5% now. So yeah, mortgage borrowers might be able to get a lower rate, but that's because they or somebody else is paying points. Now, one of the reasons new home sales has been doing as well as it has is because the builders have come up with this great strategy where they're actually buying down the mortgage rate for a lot of their buyers. So until recently, some buyers were able to get mortgage rates closer to 5%. It's a good deal for the home builder. They don't have to reduce their prices and make other people who bought homes at higher prices mad. But at the same time, it makes it more affordable for new home buyers.
So the builders, it's not like the builders are extending lines of credit to buyers. They're not giving mortgages to buyers. They're just turning to the bank and saying, we'll buy points for them.
I mean, in some cases, they have a relationship with a lender.
Right.
In a few cases, they actually can probably offer the mortgage.
Have their own financing arms?
Yeah, they have their own financing arms, yeah.
It's been a tough month for fixed income. Really tough month for mortgage-backed securities, off 2.6%. What's it like out there in the MBS market these days?
It's probably pretty tough for some investors. It's an interesting time for strategists.
Yep.
But one of the things I'm looking at this morning is actually just how different the current coupon, which is kind of where things are being issued, is versus the mortgage index. And while the mortgage index has underperformed because it's very long duration now, because people are just sitting on their mortgages forever, Matt.
I will be on it for 30 years.
So from a duration standpoint, it's going to trade pretty similarly to the 10-year Treasury, if you will. In fact, mortgage spreads for the whole index aren't widening that much. The same divergence between what you said about where mortgages are being issued right now versus what most people have is reflected in the mortgage index. So right now, the current coupon, or where the yield equals to the coupon around par, is above 6% for the first time, again, for many, many years. But the mortgage index coupon is below 3%.
Oh, all right, there
and
you
so
go.
that, yeah, I mean, I'm not saying it's not underperforming, but
Yep.
yeah,
All right,
not
Erica.
bad.
Great stuff again. Erica Edelberg, MBS strategist, Bloomberg Intelligence, joining us here. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thank you, Paul. Well, Hollywood studios have released details on their contract proposal to screenwriters. Bloomberg's Kimberly Adams has more.
The studios say they offered their biggest wage increase in 35 years, protections against the use of AI, and sending the Writers Union quarterly reports disclosing viewership for series. Details reported by Bloomberg last week. Screenwriters want studios to guarantee rewards and success. The two sides continue to meet.
Now, meanwhile, the president of the United Steelworkers says U.S. Steel doesn't prioritize its union workforce and accused it of betrayal. The union plays a key role in any transaction that involves the sale of U.S. Steel mills or assets. It supports Cleveland-Cliffs' bid to buy the company, and the steelworkers say that Cliffs can bid for U.S. Steel on their behalf. Shares of U.S. Steel right now, they are up just a fraction. And the deal is done over at UPS after union members have approved a new contract with workers. Bloomberg's Steve Potus reports.
According to the Teamsters, about 86% of employees voted for the deal, the union's highest vote ever for a contract with UPS. It adds about $30 billion in additional pay and benefits and avoids a strike that could have crippled the economy.
And checking in with shares of UPS right now, they are up nearly 1%. And Goldman Sachs is putting the pressure on its workers to get back to the office 5 days a week. Now, its human resources chief said the company is simply reminding their employees of their policy. Citigroup and JP Morgan Chase, they have been tracking attendance and even urging managers to enforce their mandates. Now, shares of Goldman Sachs right now, well, they're up just a fraction. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, stocks are higher, and Treasury yields, they are dropping. In the S&P 500, you had 10 of the 11 major industry groups in the green, being led by communication services. And then NVIDIA shares doing some of the lift there. They're up 1.7%. Well, the jobs market, that's been pretty hot, right? Well, actually, government data released today show U.S. job growth was probably less robust in the year through March than previously reported. The number of workers on payrolls probably will be revised down by 306,000. S&P 500, 26 points higher right now. That's up 0.6%. 4414 on the index. The Dow Jones Industrial Average up 78 points. The Nasdaq 100 up 161 points. That's a pop of 1% so far. Two-year yield down 10 basis points, 494. The 10-year, 10 basis points lower, 422. Tomorrow's August 24th. You know the significance of that date? Anybody?
No. I do. Oh. More people call in sick on August 24th than any other day in the year.
Somebody actually tracks this, which I find is fascinating.
Why?
I'm not entirely sure of the reason. Maybe it's just...
Dude, there's just absolutely nothing going on. I don't know about you, but for me, like...
Wait, it's NVIDIA, you know...
No, I'm just saying, yes, this year. But typically, if I have something really important at work, I'll come in even if I have COVID ×2, right? But if there's nothing happening and I have a stomach bug, I'm out.
And February 13th is the other, typically the other day where everybody just calls out. Says,
the day before Valentine's Day?
The day before.
Everybody's not shopping for that last minute Valentine's gift. All
this
right.
is a study by Flamingo.
That sounds reputable. I'm down with that.
No. Anyway, that's your Bloomberg Business Flash. Matt Ball.
All right, John Tucker, thank you so much. Matt Miller, Paul Sweeney here in Bloomberg Interactive Broker Studio. We are streaming live on YouTube.com, so head over there and search for Bloomberg Radio, and you get it. You know, in this market this year, and particularly in the month of August, it seems like the equity markets are kind of following what's happening in the bond market. And August is a time we saw rates move really higher in the Treasury market, and kind of a tough sailing there for equities. I'm looking at today, the 2-year and the 10-year Treasury, both down 10 basis points. That gets your attention here. We got a little move up here in the market, but I have no idea what I'm talking about. But I know we have people on this show, Matt, that really do know what they're talking about. Omar Aguilar, he's the CEO and the CIO of Schwab Asset Management. Omar, what is your market call here, looking at some of the volatility we've seen in the bond market this year, and particularly over the last 3, 4, 5 weeks?
Hi.